this morning at this early stage. So here's the FTSE 100 out of the gates and up by just 0.1%. Mixed picture on FX. The weakness in the dollar is of interest, as we were hearing from Mark last hour. That weakness in the dollar helping some assets through the Asia session, he was pointing out. The pound up by 0.1%, the euro fairly flat this morning. We're seeing buying of sovereign bonds. The 2-year horizon, we see the UK yield coming down. Those gilt markets just opening up then this hour. We see an interest in the 30-year tenure as well for a number of these markets. And that's interesting because we have an auction taking place at the long end of the US curve today. So we'll certainly keep an eye on that. So here's the positive picture we were waiting for, Tom, when it comes to the European equities. We are up by 0.5% on the Italian, on the French market, a little bit less than that over on the Spanish IBEX and the FTSE 100. So some positivity coming through. Retail is going to be an area of focus. Yesterday we saw Sainsbury's dropping on its update to the market, but its failure to upgrade its guidance. Today we've seen a more positive story coming through from at least one of the retailers. So we'll keep that in mind as we look at what's going on with sectors.
Across the main 12 sectors then, it is the personal consumption sector that is just about in the red. It's just ticked higher. Every single sector now that we monitor here, every major sector of the 12 in positive territory. The strength really coming through for basic resources. So look to the miners listed on the FTSE 100. That sector, after the softness that we've seen in the last few days, it was the biggest loser as a sector yesterday. Currently, basic resources, though, up 1.2%. You're seeing gains as well, pretty decent gains coming through for the tech sector, up close to a full percentage point. We have a very decent session over in the US. Once again, tech-led gains coming through, particularly for the NASDAQ, which ended up about 0.7% higher. Financial services also getting lift up 0.7%. Autos higher as well, up 0.7. That's going to be lifting the DAX over in Germany. And the industrials getting a decent session as well, up 0.7. A little bit flat when it comes to food and personal consumption, but currently across these major sectors, as we can see, green on the screen. This one is just hovering between flat and negative. Across the European benchmark, you're seeing gains eking out 0.5%, a pretty decent session so far in the first few minutes or so here in Europe this Thursday.
Yeah, it seems to be getting very stock specific. So we've got Tesco rising, Marks & Spencer's dropping, very much in response to the individual reports we've had out from these retailers. We'll get to that theme shortly and dig into some of the detail there. Let's talk to Sam Unstead, who joins us from the Markets Today blog and can take us through some of the things we're focused on this morning. And let's start with Bitcoin and the Bitcoin ETF. This has been something that's really captured the market's attention, whether you're a big fan of Bitcoin or less so. It seems to be something that the market was watching very closely, to what extent the establishment, I suppose, would embrace this crypto product. And we know the answer to that now, Sam.
Well, we know the answer, certainly, that it's been approved.
Yep.
I think the question of how much it gets, how much it will be embraced, is, that will kind of be answered over the next couple of weeks. Those ETFs start trading today, some of them, so we'll see, some activity there. I think what you're now going to get, that will have to settle out. You'll probably see quite a big rush of money into those over the first week or two. That may then settle, and then really that's when it becomes part of the broader system, and then we see how it performs within that. But I think all the existential questions that do get asked about Bitcoin, from the skeptical side, I don't think they're going anywhere.
I wonder to what extent the moves by the SEC, the approvals, are going to affect or impact or feed into the decision-making of other regulators globally. The Bank of England has been talking about crypto. Is the Bank of England going to take the lead of the SEC, or are you seeing more scepticism?
Well, certainly from yesterday, scepticism still. And actually, so Andrew Bailey, in front of the Treasury Committee yesterday, sort of said that he sees, as far as he's concerned, that crypto is not making that kind of progress into the core financial system. So being used as a payment product, there's kind of everyday uses that you would have for a currency. So certainly at the moment, and certainly UK regulators as well, do seem far more sceptical. Well, maybe not far more sceptical, but certainly they are where the SEC was, but there's no products to approve yet.
Okay, so that's the link between crypto and where it comes onto European shores, and thinking about the UK policy response. We heard from Andrew Bailey, though, on a number of subjects yesterday, didn't we? He was talking about the financial stability report. Let's just have a listen then, Sam, to some of the words he gave us around the macro themes.
We have not seen a pronounced increase in unemployment. We've seen very little increase in unemployment. That's relevant because historically one of the drivers, and if you sort of analyse it sort of statistically, one of the drivers of loan losses, particularly in the mortgage market, is unemployment. And the second one is associated with that certainly last year we saw actually an increase in around about a 2% increase in household real incomes. Both of those things support, obviously, overall conditions and financial stability.
So really interesting there on the unemployment side. I mean, nobody wants to see job losses in a very human sense, but to some degree, some loosening of the labour market in some way is what the Bank of England would appreciate seeing as a signal that maybe the economy was not as hot as it was previously, and therefore leaves the path for cutting rates. That doesn't sound like somebody who's waiting to cut rates.
No, that's true, and I think you're right. The signal they're waiting for is that weakness or softening in the jobs market that is going to hit wage growth. Right? We get jobs data next week. It's still jobs data that is in a transitional phase. So how much to put into it is a question, but. We've already had actually this week a couple of reports out from recruiters, private recruitment companies. Net fees are going down, placements are going down, temporary and permanent, and wage asks are also starting to dip a little bit. So within that private sector, you are seeing this start to happen. So yes, he's right. Everything is moving kind of very slowly, softer, but it is moving in that direction.
The temporary recruitment story was interesting. Hayes, that was a real big drop that day, wasn't it?
The post office scandal. I mean, anyone here in the UK cannot move. For the coverage that's come through. Finally, belatedly, many would argue, after kind of 2 decades. And now, again, belatedly and finally, the government is actually acting on a scandal that, of course, has engulfed Fujitsu, the government itself, and lawmakers of all stripes, as well as the post office. And now the Prime Minister is proposing some legislation. Will it finally address what has happened, this scandal, and actually lead to some recompense for those affected?
Yeah, so I think if you're looking at this story, this is a very emotive story, and at the moment that's the phase that this story is in. And so from a market's perspective, there's not a huge amount of movement, or at the moment. But so yes, this phase of it, exonerations, potentially compensation, that's one part of it. But this will rumble on for quite a long time, and we've got an election coming this year. And so how this is handled by the government, and then how Labour position themselves as well, will go into that picture of election risk, going into the second half of the year.
We talked a lot about the frenzy for Japanese stocks recently. Well, Fujitsu is underperforming today, I noticed, and one of the things being quoted in the local market is perhaps having an impact on their ability to get contracts in the UK, which wouldn't be a surprise.
Yes.
After the amount of coverage.
Yeah, I think that's right. I mean, that's the most sort of direct impact. But we're still a little way from that yet. I think that at the moment we're still in the phase of it being a much more political story than a market story, but it could indeed become a market story.
Those multi-billion-pound contracts that Fujitsu has managed to carve out with the UK government, and some suggesting, or at least pointing out, that they are very much integrated into Whitehall. And so unpicking that, if that's where it ends up, is going to be complicated and expensive. But maybe there's the political pressure now for that to be considered. Sam Unstead, thank you very much indeed. Of course, from our Markets Today blog. You can get more from Sam, the rest of the team, on the front page of the UK website. Of course, Bloomberg, type TLIV Go if you want to access it via the terminal. Coming up, Britain's biggest grocer, Tesco's, rising in the session after raising its profit outlook. M&S, meanwhile, sinking to the bottom of the Stoxx 600 after its trading update. We look at your stocks to watch and your stocks on the move. That is next. This is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Welcome to the world of decent decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
This is Markets Today. We're 11 minutes into our European trading day this Thursday, and European stocks actually quite positive this morning, up by around 0.6% on the Stoxx 600. Some really interesting stories in the mix. Let's get a briefing on the individual stock moves. Joe Easton has that for us. Joe.
So we've got some excitement here in UK retail. Firstly, Tesco coming up around 1% at the moment. They did raise their profit guidance, something we didn't see from Sainsbury's yesterday. They seem to be cutting prices, stealing market share here in the UK. But meanwhile, Marks and Spencer's down as much as 5%. This is one of the best performing stocks we've had in the UK after a couple of years, but they haven't raised their profit forecast. A similar thing we did see from Sainsbury's yesterday, as I say. And also clothing, pretty weak, only up 5% in the last 16-week period. Food doing well, but clothing does look to be disappointing, and those shares seem to be affected by people taking profits on some of those big gains that we've seen. Whitbread here in the UK as well, the owner of Premier Inn, reporting some pretty strong numbers in the last period, so that one coming up 2%. But a decliner today is Boohoo. Panorama about to release a documentary saying that the company actually labelled some products incorrectly, said they were made in the UK when they were in fact made in Asia. Boohoo said in a statement that this was due to human error, and they have corrected it, but that is set to be broadcast, and that is weighing on that stock at the moment. So lots of things going on there. It's not just a share price fall, it's an M&S share price fall. I thought I'd throw that one in. I'm pretty pleased with that one. In terms of those luxury stocks, Hermes, this one is upgraded at Goldman. We had it over in stocks to watch, so that one comes up to neutral, whereas they downgrade Swatch, and I'm also hearing from some trading sources that there's another broker move weighing on that one at the moment, so keep an eye on the terminal, and we will try to confirm those ones. In terms of some ratings here in the UK, British Land and Land Securities both upgraded at Berenberg, who think that with the interest rates coming back down in the UK, that could potentially mean a bit of a revival in UK real estate, something we haven't seen many commentary on before that much at all in terms of those. So both of those gaining more than 1% today in London. On the final board, we are a little bit ratings heavy today. We're heading into earnings season, so we're getting analysts adjusting their forecasts, and Bank of America downgrades Lufthansa. That one's had a good run given the rebound in long-haul travel, so that one is cut to underperform over there. Nordea Bank, the biggest bank in Sweden, that one downgraded by JP Morgan, so falling 1.3% today. And Antofagasta, a London-listed miner, upgraded this one over at RBC. They think the copper price coming up should benefit that one. And finally, just a cheeky bit of M&A to finish off with Pagero. This is a payments company, a Swedish-listed payments firm, getting a takeover bid from Thomson Reuters. So that one rising 16%, one of the biggest gainers in Europe today. Lots of movers to bring you this morning.
OK, love a cheeky bit of M&A. Joe Easton, thank you very much indeed from our equities team on some of the stocks on the move this Thursday morning. Now to the macro, and the Spanish central bank chief says the euro area probably failed to grow in the final 3 months of last year. Pablo Hernández de Cos says all available indicators suggest the region stagnated in the fourth quarter. Let's get more from Helen Jewell now, Chief Investment Officer for BlackRock Fundamental Equities. Mia, Helen, I want to start with your outlook for 2024 because it's pretty constructive. You do think the equity momentum continues. We'll get your views, of course, on the ECB, but I want to start there and the assumption, to what extent does that positive view, the momentum, the upside coming through for equities, we're certainly seeing a strong session today, is that based on an aggressive rate-cutting cycle from these central banks? How fundamental is that to that view?
Yeah, it's a great question and great to be here, but I don't think it's actually that fundamental. I think what is fundamental is not being on either of the extremes of where we might be in terms of inflation and in terms of growth. So we don't necessarily need huge rate cuts. I think it's been so long since we were in a kind of 5% rate environment that we've forgotten that equities can actually perform really well around 5%. What hurts equities is very, very aggressive rate hikes, and what hurts equities is uncertainty. So as long as what we're seeing coming through is not on those extremes of either incredibly hot inflation, which will cause rate hikes, or real slowing growth. I mean, even if growth stagnates, I really don't like that word in terms of it's so negative, isn't it? But even if growth remains relatively kind of soft and stable, I think it will still be okay. We have consumers with money in their pockets. We're seeing consumers spending that kind of money. And that's what comes through into equity markets, comes through into earnings, and comes through into the kind of growth that I think we will be seeing in 2024.
OK, what kind of returns can stocks deliver then, Helen, if we don't get rate cuts this year? Because we do have a number of guests come on and talk about how the market is overly anticipating rate cuts in all kinds of geographies.
I think what we'll see then is just much more normal levels, the kind of 7-8% levels that, again, we saw historically, pre-financial crisis. I mean, that's what the normal levels of return are for equities when you see interest rates at these kind of levels. And again, compounding, that's a good place to be. We'll come on to stock picking. I'm an active stock picker, so of course must put a push in for that as well. But I think people have forgotten, if you actually look at where the stocks is today, the stocks is pretty much at exactly where it is, give or take a 10 or so, 2 years ago today. The valuation level is much lower. So 2 years ago today, stocks was at, around about 490. Today it's at 470. 2 years ago, 17.6 PE. Today it's more like 13.6. So some really interesting valuations. I think because 2022 was so bruising when we saw those big interest rate hikes. And then 2023 felt so great because, of course, we saw the equity market really rally and rally pretty considerably, double-digit rallies, that we're forgetting what normal looks like in equity markets. And I think that's where we are now. Sounds a bit boring, but normal.
Does that valuation gap then that you talk about between US, Europe, does that start to close this year? Or do things like catalyst things like, for example, the Inflation Reduction Act, that stimulus, AI, which kind of favours the US as well, continue to keep that gap relatively wide?
Yeah, I mean, it's one of the key things we're looking at. The valuation gap now is around 35% between Europe and the US versus a traditional of just over 20, about 21. So we are seeing a much wider valuation gap. But I think I've been on here many times talking about that valuation gap. And you do wonder, firstly, you do have more value names in Europe. And secondly, maybe some of that momentum, some of the AI, some of the decarb and the reglobalization, deglobalization that we're seeing perhaps favours the US just that little bit more. Having said that, I think there are a lot of companies in Europe that do benefit. So in my view, that gap is too big, and I do think we will see that shrink. And again, it comes back to that multiple. European market looks pretty decently valued right now. So I do feel positive about the European market, but I don't think it's going to get back to that historic average because of those mega trends just favouring the US that little bit more.
What's the role of public spending in your view then, Helen? Because we've seen a period where governments were having to spend a lot of money during the pandemic, and now a lot of governments are talking about still spending some money, but on very specific things, energy transition, for example. How does all of that add up to a net positive or negative for European stocks?
So it is a real positive. It absolutely is. And of course, you've got a lot of elections coming up. It's very important for governments to be much more specific about what they're doing with the money that they've got and where they're planning to put that money at play. So it is really, really important. It's a real beneficiary for a lot of the industrials companies that we see benefiting from a lot of the decarbonisation plans. And also a lot of the companies that you might not think about, the companies that produce copper that is needed for electric vehicles, the companies that help with the infrastructure that is needed. So that flow of money and that flow of capital is incredibly important. But I think what we're also always looking for is a little bit more detail of exactly how that will flow through, and I'm hopeful that this year, a lot more elections coming through, that's maybe a real catalyst for getting some of that detail.
How do you see the margin story evolving in a lower inflation environment?
Yeah. Now, this is a really interesting one with margins. Margins have been a real tailwind for equities because you've seen that margin expansion. And when inflation comes through, what you tend to see is that real dispersion between those companies that are able to manage that inflation versus those that are not. Now we're in much more of this normal environment. I think what we're much more focused on are those companies that really have got the ability to really understand where it is for their costs, manage their costs effectively. And that's what we've seen again even this week, those companies coming through with kind of much more detail about how they're managing costs, how they're managing it against inflation. But again, a much more normal environment. Gives you a bit of dispersion, and that's what we're most excited about.
Helen, thanks very much. Thanks for joining us. Helen Jewell, Chief Investment Officer for BlackRock Fundamental Equities EMEA. We thank Helen for joining us this morning. Coming up on the programme, we'll dig deeper into the UK retail story this morning after Tesco and M&S give us divergent views, and their share prices started off the day in different directions. We'll get an update. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Markets Today. 23 minutes into our European trading day. We've got European stocks making gains this morning. Let's turn to the retail space. The UK's biggest grocer, Tesco, has raised its profit guidance slightly after the supermarket chain saw a jump in sales during the approach to Christmas. Marks & Spencer has also reported strong holiday sales. There was some divergence between the share prices. Let's check in on that with Charles Allen from Bloomberg Intelligence, who joins us with more. So let's start with the Tesco story then. Just how positive is that Tesco story then, Charles?
Well, I think it was, broadly speaking, it was expected, but obviously we had Sainsbury's yesterday, who also produced very good food sales, but they had a big general merchandise arm which didn't do quite so well. Whereas Tesco has really sort of exited, apart from clothing, a lot of the general merchandise. So it was right on the food, and that meant they had another strong performance, and they're able to raise their retail operating profit by about guidance by about 4%, but the financial services was unchanged. So in total, it's only about a 1% above consensus.
How much of this is down to kind of aggressive cost cutting from the likes of Tesco's and even Sainsbury's when it comes to food items, or is this a more resilient consumer?
No, well, I mean, both to a certain extent. I mean, they've all aggressively cut costs because Aldi and Lidl are lower cost operations. They have Aldi price match. The only way you can do that is if you're a lower cost operation. So that was, that's something we've been seeing for the last 2 years. But equally, Tesco Finest sales were up 17%, and, we saw Marks and Spencer's volumes up 7%. So consumers are spending on the more upmarket premium products as well.
Does the mixed reaction then look sensible to you today? So we've got Tesco share prices up a little bit, but M&S down by 3.7%.
Well, I think, for M&S, it's sort of tough call because the pre-tax profit estimate, consensus pre-tax profit, is up 80% this year from this time last year, but for all that going into this announcement, there was probably an expectation that it could be raised further, and they just basically said we'll meet market consensus. So not really enough.
The Red Sea impact, Charles, and the fact that some product is having to go the longer way around. I mean, Sainsbury's talked about this. Next has talked about this. This is something that businesses are trying to manage, I suppose.
Yeah, I think basically it adds about 10 days to when your goods will arrive. So it's not probably absolutely critical, and it adds to the cost a little bit, but it's not a huge deal, I don't think, at the moment.
Okay. Charles Allen, thank you very much indeed from Bloomberg Intelligence on the analysis there on the sales coming through from Tesco's and M&S. M&S currently at the bottom of the list when it comes to European stocks, currently down close to 4%. Tesco, of course, having a more positive session. Coming up, a boost for Bitcoin after US regulators approve ETFs investing directly in the digital token. We discuss what the approval means for the future of crypto. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Market markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Markets Today, 30 minutes until the 30 minutes into the European trading day. Here are your top stories. European stocks and US futures move higher ahead of today's US inflation print. JP Morgan says the Fed might cut more than it's signaling. Shares in Tesco rise as the UK grocer raises its full-year profit guidance after record Christmas sales. But M&S falls on disappointment over its international business performance. And Bitcoin spot ETFs get the green light a decade after the first proposal. But the SEC warns the approval is not a cryptocurrency endorsement. We'll talk more about the crypto story in just a moment, won't we, Tom? But for the moment, let's sort of luxuriate in the positivity around European stocks. And we're heading towards that crucial US CPI print.
Indeed, and whether or not that CPI print derails the risk-on rally that we're seeing, not just in equities, you're seeing it in commodities as well, you're seeing it in debt as well. Sovereign debt, treasury yields are coming in across the curve. Currently then, across your benchmark here in Europe, gains of 0.6%, closing into 480 on the European benchmark. The DAX is closing into 17,000, adding 117 points, up 0.7% so far in the session. The auto sector is performing pretty well. The FTSE 100 lifted by the basic resources story. You are seeing higher prices in the session today, at least for iron ore and copper. Basic resources getting a big lift as a sector, and the FTSE 100 benefiting, gaining 0.5%. But the grocers as well, bit of a mixed picture, as we've been saying, with the M&S story near the losers, the biggest losers on an individual corporate story on the back of the sales numbers. Tesco's those performing better. On your sectors then, let's flip the screen and see how things are breaking down across your major sectors. At the start of the session, every one of these major sectors was in positive territory. Now, just a little bit of downside coming through for the banking sector. But again, the strength from basic resources, 1.5% so far in the session. Decent session as well for industrials, gaining 1%. Energy, very modest gains of about 0.1%. Tech had been performing better. That's come off a little bit. There's been a strong handover from the US and Asian sessions, in fact. Financial services and the auto story, again, as I mentioned, for the DAX, the lift there, 1.4% for that sector. And personal consumption, this is the grocer story then coming through for this sector, just a gain of 0.1%. Across the benchmark, gaining 0.6% at 479 annum.
Okay, so that's the picture across European stocks. Looks pretty positive, as you say, heading towards that key data print in the US. Some of the big news out of the US over the last 24 hours has come in the crypto space. US regulators have finally given long-awaited approval to exchange-traded funds investing directly in Bitcoin. The move, which pushed Bitcoin briefly above $47,000, has been heralded as a landmark event for digital assets such as Bitcoin. ARK Investment Management's Kathy Wood discussed the implications of this decision on Bloomberg's ETF IQ show.
We're even speaking with state pension funds, as well as even some treasurers. So the interest is far and wide, and certainly we're satisfying a lot of curiosity out there right now with meetings.
Joining us now, Marianne Labor, who's Senior Strategist at Deutsche Bank Research and the author of Democratizing Finance. Marianne, very good to speak to you. So can I ask, do you expect this to be positive? Well, do you expect Bitcoin to keep rising this year? And if you do, is it to do with this ETF, spot ETF approval, or is it to do with the halving process? What's the big picture outlook?
Thank you very much for the invitation. Very glad to be there. Yes, we anticipate further price increase this year, and I would say for three primary reasons. First, as you just mentioned, the approval of Bitcoin ETF opens the door for greater institutional investment. Clearly, a spot Bitcoin ETF will make it easier for investors to gain exposure through a regulated vehicle, and it's potentially more appealing to both retail and professional investors. So this could drive large inflows into the market. Second reason, we expect as well central bank rate cuts this year, and it's going to drive more investors investors probably to invest in crypto for higher returns. And as we've seen during the COVID era, the macroeconomic landscape was characterized by low interest rates and high liquidity, and it created a one-of-a-kind environment for the growth of non-traditional investment like cryptocurrency. And we expect the Fed to cut rates by 175 bips next year, the ECB to cut rates by 150 bips this year as well. So this could once again stimulate liquidity. And the third reason why we also expect price to increase is because regulation is coming. If we look at what's going on in the EU, MiCA regulation will come into effect this year. The stablecoin rules will kick in this term, and we have the full application of all the MiCA rules by Q3 this year. In the US, the holistic rules are still lacking, but regulatory authorities have made a lot of penalties. I'm thinking about Binance and Coinbase, and we have half of all actions made last year by the CFTC, which involved digital asset.
Yeah. Mario, you talk about higher prices then as we look at kind of 46,000 or so for Bitcoin right now. Give us your target for pricing. Standard Chartered says potentially $200,000 per coin by 2025. Does that seem rational to you?
We don't have any price target for Bitcoin. Again, the natural sentiment is to expect Bitcoin prices to increase. However, I should mention as well that we did a December consumer survey. So we have interviewed Americans, Europeans, and unexpectedly, actually, a third of consumers expect the price of Bitcoin to remain below 20,000 this year. And only 9% anticipate Bitcoin prices to rise over 50K. Yeah.
Okay, that's interesting. Mariam, when you look at the factors that support valuation of Bitcoin, even if you don't have specific price targets in mind, when you subtract out the sort of the cult around it, I suppose, or the sheer belief that many of its enthusiasts demonstrate, what else supports the value?
Yeah, as I just mentioned, again, the approval of a Bitcoin ETF clearly is going to drive some inflows into the market, cuts, central bank cuts as well, and regulation.
But none of those change the underlying asset, do they? I mean, I understand why you're saying that they might drive prices higher, but when you're looking at what supports the value of the underlying asset, what else is there in the mix?
Yeah, not much actually. And if we look specifically at a spot Bitcoin ETF, it basically simply provides a standardized access to the digital assets as an investment. And it doesn't alter, as you just mentioned, Bitcoin's core proposition. So we haven't seen much differences so far in terms of the Bitcoin's core proposition. So only time will tell us.
Mario, just to build on Anna's point, I mean, what is it for? We still haven't answered the question what Bitcoin is for, what its utility is, what its proposition is.
That's the main question, actually. We are still looking at that, and I mean, half of people think that there is no value proposition. The other half thinks that yes, we have a value proposition. Again, I would consider Bitcoin as something where I see a value proposition personally. Supply is limited, and from my point of view, Bitcoin and Ethereum are likely to stay here. It's not the case for all cryptocurrencies, again, but with Bitcoin, yes.
Is this going to open the door, Mariam, do you think, for further regulatory... well, you've talked about some of the regulatory environment that's coming in Europe and the US, but in terms of the ETFs and approval of ETFs, we've seen it for this spot product, but are we going to see other cryptocurrencies given similar treatment, or is that going to take a long time?
Yeah, I can't comment on that, unfortunately, but there are, again, with ETF, risk factors related to the spot Bitcoin ETF that I should probably mention. First, we see that any incorrectly executed transactions or stolen Bitcoin can have an irreversible and negative impact on the spot Bitcoin ETF. We are also seeing like another risk factors, which relates to the custodian, because the issuers of the spot Bitcoin ETF will rely on custodian. So if the security of the custodian is compromised, it might lead to operational disruptions and potential divergence of the ETF's share values from its net asset value. The third risk factor that we are seeing is the treatment of digital assets at the U.S. federal, state, and local income tax regulation, because it's still unclear. And the fourth risk factor that we are seeing is the liquidity of the spot Bitcoin ETF that may also be affected by the activity of authorized participants.
Okay, so Marion, those are some of the risks and worth highlighting, of course. When you touched on inflows in your first answer to us. Talk to us about what you expect to see in terms of those flows. Now you've got the SEC approval for the likes of Fidelity, for the likes of BlackRock. What are the flows likely to look like in the next 6 to 12 months?
Yeah, I mean, our view, again, we don't have any price expectation, we don't have any inflow forecast, but this could drive large inflows into the market. Bitcoin supply is limited, so when we have increased demand amid constrained supply, this would put upward pressure on prices. And we have already seen prices climb significantly this year on anticipation of the decision. And that's why I was mentioning also inflows in terms of price increase for Bitcoin earlier.
Okay, Marion, thank you very much indeed. The take there, the analysis, given this consequential decision by the SEC to approve these Bitcoin ETFs. Currently, the cryptocurrency trading at 46,239. Marion Labor, senior strategist at Deutsche Bank Research and author of Democratizing Finance. Let's get to some of the other top stories this morning. In AI, artificial intelligence news, of course, OpenAI is in talks with CNN, Fox and Time magazine to license their content. It's part of an effort to secure access to news stories, to make the AI chatbot more accurate and relevant. The development comes as OpenAI faces lawsuits alleging copyright infringement.
Luxury goods maker LVMH is in discussions with the social media app TikTok on a plan to limit the sale of counterfeit products on the platform. TikTok is aiming for $17.5 billion in e-commerce business this year. The deal could be a major move to help improve the reputation of TikTok Shop among brands and shoppers in key new markets.
And Morgan Stanley has elevated 155 employees to managing director. It's a smaller number of promotions to the firm's top rank than last year. Sources tell Bloomberg that women account for 37% of the promotions. That increases the overall share of female MDs at the bank to 26%.
US Transportation Secretary Pete Buttigieg has dashed hopes for a quick return of Boeing's MAX 9 planes. He says they will remain grounded until regulators deem them safe, adding, quote, nobody can or should be rushed. Boeing is facing intense scrutiny after last week's accident. Coming up, why the US wants to ask Volodymyr Zelensky to sharpen up his battle plan. The latest on the war in Ukraine next. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture down.
Is it the OK's getting ready to make a decision?
Happy Thursday. This is Markets Today, 45 minutes into the European trading day. Risk on across these markets. Equities in Europe gaining 0.7% on the European Stock 600. Bottom of the list, though, when it comes to your stocks, Marks & Spencer's taking a hit of close to 5%. Top of the list, near the top of the list, the likes of Antofagasta, the miners, basic resources performing very well, along with autos, some of the key gaining sectors. So far in the session, US futures also pointing up by about 0.3% on the S&P E-minis, Anna.
Okay, the former New Jersey governor, Chris Christie, is ending his 2024 presidential campaign. He was the most anti-Donald Trump candidate in the Republican race. Christie's exit could be a potential boost to the candidacies of former UN ambassador Nikki Haley and Florida Governor Ron DeSantis. The US and its allies are weighing options for retaliation against escalating attacks in the Red Sea by Houthi militants. The Iran-backed group launched their largest missile and drone attack to date on ships on Tuesday. The White House has been considering military strikes on Houthi targets in Yemen, despite the risk of a regional escalation.
If these attacks continue, as they did yesterday, there will be consequences. Again, this represents a clear threat to the interests of countries around the world, and it's important that the international community come together and respond to them.
Okay, staying on geopolitics, and the US is expected to call on Ukraine to sharpen its battle plan in the war against Russia. US National Security Advisor Jake Sullivan is likely to raise the issue with President Volodymyr Zelensky in Davos next week. Let's bring in Bloomberg's Bill Ferries with the details. Bill, what exactly does Washington want then?
Well, it looks like Washington wants a pretty clear plan of how Ukraine's going to make some breakthroughs. You'll recall that about a year ago, as we were heading towards the spring, there were high expectations that Ukraine would break through some of those entrenched Russian lines and retake even more territory. That really didn't happen. Heading towards the third year of this war, Washington wants to see some progress. There's also a lot of concerns in the White House that President Zelensky and his top army advisor don't see eye to eye on strategy, and that perhaps that disagreement is delaying some progress on putting together this plan. Of course, political support has been starting to wane, particularly in the Republican side in Washington. That's also factoring into President Biden's calculus as he heads into the 2024 election. So a lot of different pieces there, but the broad concern is that the U.S. would like to see Ukraine with a clear battle plan that can show some progress in the coming months.
And what impact will the White House support then for legislation allowing it to seize and use frozen Russian assets? What will it have?
Well, it's hard to know right now. The White House has signaled that it's willing to support legislation making its way through Congress that would allow it to seize up to $300 billion in Russian assets held abroad. The big challenge is that most of those assets are not held in the United States. About $200 billion are held over in Europe, and European support for seizing those assets is not as high as it is in the U.S. I think one thing the White House is trying to do here is find ways to get political support to get its Ukraine aid package passed. This may be a way to win over Republicans who are wary of continuing to spend U.S. taxpayer money on Ukraine.
Bill, thanks very much. Thanks for joining us. Bill Ferries there with the latest on the Ukraine situation and its funding. Coming up, we will look ahead to today's US CPI report, which is expected to give a preview of coming disinflation. We'll dive into some of the detail there. That's next. This is Bloomberg.
watching and says, I want to be Ari Emanuel when I grow up? What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
My base case is that the current restrictive stance of monetary policy will continue to restore balance and bring inflation back to our 2% longer run goal. I'll expect that we will need to maintain a restrictive stance of policy for some time to fully achieve our goals.
That was Federal Reserve Bank of New York President John Williams on getting inflation back to the Fed's inflation target. We're 52 minutes into our European trading day. On inflation day, we're going to get that inflation report out of the US later. This is the picture on European stocks, though, in the run-up to that data print. And it all looks pretty positive, up by around 0.75% on European stocks broadly. Some of the best performers coming through on the German market, up by 0.9%. But actually, all sectors are in positive territory. Energy is the closest to negative, but even that's up 0.1%. The best performer, autos and parts, up 1.5%, which of course speaks to Germany's strengths. Let's talk about what's happening in the markets and focus in on that inflation report to come. Ven Ram joins us from our Markets Live team. And Ven, I was just pulling up the Waco function on the Bloomberg, just double checking that the market is still expecting that CPI year on year will tick up from 3.1 to 3.2% this time around. But you make the point in your notes that economists have been overestimating inflation of late. How does that factor into what you're expecting today?
Morning, Anna. Yes, indeed. If you notice the economists' expectations in the past 12 months, they've been overestimating inflation by about 10 basis points. So that kind of suggests that if that is true to form, it suggests that the CPI readings today may undershoot the projections. Even so, if you're going to get headline inflation of around 3.1% and core inflation of about 3.7%, that's not going to be enough for the Fed to say, you know what, we need to cut rates imminently. And that's the pushback we got from John Williams, where he mentioned, rates need to stay restrictive for some time. And even more emphatically from Raphael Bostic earlier this week, reiterating the message that, look, he's not looking to cut rates before the third quarter. So on the CPI prints, we may get a mild knee-jerk rally, but I don't think that is sustainable beyond the short term.
Okay, the distinction between the forecast, the moves around the forecast, and the actual numbers being highlighted in your piece, Ven. You talk about some of the Fed speak, some of those Fed officials. Where do you land then, Ven, in terms of for some time what that means? Is it the third quarter, as Bostic suggests?
I don't think they're going to keep rates that long because real rates are now restrictive. I don't think we are going to get a winter cut, i.e. on March 20th, but I do think that, maybe in the second quarter is when they start reducing rates. But I think that markets may get about 4 rate cuts. The Fed, as has penciled in 3. I think that we may get 4 or 5 rate cuts possibly this year.
Let's pivot our focus to the other side of the dollar yen trade, at least, Ven, and talk about what's going on over in Japan. How is your thinking around Japan evolving? There seems a lot of focus on Japanese stocks at this point. How are you thinking about Japan as we head into 2024?
I think Japanese stocks have a good prognosis, particularly because if you think that the BOJ is going to normalize rates. They are not going to raise rates by a whole lot like the ECB did, like the Fed did. We are talking about very mild policy normalization. And if you were going to discount Japanese stocks at, at say 20 basis points as opposed to minus 0.1% now, I think that the fair value of Japanese stocks is still going to be remarkably high. What is impressive about Japanese stocks is if you look at the dividend yield over the past 10 years, it has outstripped growth in the S&P 500. So the relative allure of Japanese stocks remains intact. And if you're a US portfolio manager, you're basically getting paid to hedge, to hedge your FX currency risk. And that will continue to be a case because the Bank of Japan is going to keep rates lower than the Fed, obviously. And therefore, I think that the prognosis for Japanese stocks is quite good.
Okay, still potential further upside for Japanese stocks after the strength that we've seen over the last 12 months, and again, pronounced over the last 2 days, with gains of close to 2% once again on the Nikkei today, which closed above 35,000. Of course, Anna, our focus does switch to that CPI print that Ven was talking to us about, with core inflation expected by the forecast, and he was giving us the context around that, to come down to 3.8% from 4%.
Yes, indeed. So that could be the move that the market chooses to focus on if it's looking for signs of disinflation, which is where the market's thinking has been. Interesting that yields did tick up in the first week of January, but have been coming down a little bit. Certainly the 2-year, I was reminding myself of that, currently at 4.33% as we head towards that inflation print a little bit later on. That is it for today's Market Today. You can find insights from the team on the Bloomberg website or TLIV Go to follow the blog. This is Bloomberg.
On the product may read made in the USA, but the sign on the CEO's door often says made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Investors await U.S. inflation data that will help clarify the path for Fed policy, or at least we hope. The New York Fed president says rates are high enough to guide inflation back to target. A breakthrough for crypto as Bitcoin spot ETFs get the green light a decade after the first proposal. But the SEC warns the approval is not an endorsement. Plus, bumper grocery sales for two of Britain's biggest retailers over Christmas as inflation hit consumers spend on food rather than gifts. More on this and other stories in our weekly UK show. Now, first thing is first, so let's take a look at the markets, and this is what the European markets are telling us right now. Now, let me be very clear. These markets are on tenterhooks because they're expecting that inflation data print out of the U.S. to give us an indication of what that means for the Fed, whether we cut as much as expected in the markets, whether there are less cuts, and of course this reprices and changes everything. For the moment, the CAC 40 gaining some 0.6%, the FTSE may have been into the 0.8%, and of course some of the individual stock moves that will delve into a little bit deeper. Tesco up, for example, after it's raised its profit guidance, and Marks & Spencer dropping after its third quarter sales reports. But to talk about inflation, treasuries, data, and everything in between, talk about the markets. Joining us now is Lucy Baldwin, Global Head of Research and Equity Advisory at Citigroup. Lucy, so good to see you. So thank you so much for coming on. It's a big day. It's a huge day, but I feel like the main question is whether you think the markets will start tracking maybe some of the data a little bit instead of just believing that there are cuts coming no matter what.
Yes, good morning, Francine. Great to see you. Yeah, you're absolutely right. We had the everything rally at the back end of last year, fueled by this sort of hope, reign eternal theme, whereby everybody thought, okay, it's fine, we're going to get these sort of insurance cuts, we're going to get cuts early. Our view is quite different to that. We actually don't think that's going to be the case, and we think the risk as we look into this year is that you get a recession. We actually think that you're going to see cuts more towards the second half of the year. So the kind of concept that you'll get a potential cut in March to us feels like too much excitement too quickly for the US market. So the big theme for us is this delay in the easing cycles really coming through this year, and that's what we're expecting to see for the US, but also for some other key markets around the world too. And you're absolutely right. We do think that the data is going to become much more important rather than moving in advance of that data.
Yeah, I mean, so that will probably be a welcome relief by most. So is it because you're expecting actually inflation to fall less than expected, or is it because you have other worries about the economy that means that the Fed will hold back for now?
Yeah, you know, our view really is that, yes, we've made tremendous progress around the world on inflation, but this kind of last mile we think is going to probably be a lot tougher than people think to really bring it down. And we do think that we've obviously seen at the back end of last year massive moves in terms of rates, right? Obviously, the move in the rates market is quite unusual. What we saw in the last 2 months is usually what you see when you're in a cutting cycle and when you're in a recession. So to have seen that then was quite surprising. And so to our minds, you know, that's created now quite a sort of fuel really to the fire, and the US doesn't need much more fuel in that fire, as we know. So we're actually really watching the data very carefully, in particular the consumer data. Of course, you know, what's happening with jobs, and we can see already it's taking people longer to find that new job. People are out of work longer. The confidence has already started to dip. And crucially, I think, you know, as we press into the sort of end of the first half of this year, we think it could be quite non-linear, the way that the labour market weakness manifests. So we're really watching that data set particularly closely.
So, Lucy, are you actually expecting some kind of hard landing in the U.S.? And we're in an election year, so would, you know, the Biden administration not throw everything at it?
It's a great question. We have agonised over this, Francine, and we are probably the most bearish bank macro-wise on the street. So we do still forecast a recession for the U.S. It's a pretty mild recession, really, but we do nonetheless forecast one. And we think this kind of concept that you're going to see this soft landing is just too positive. So, you know, the view that you get a soft landing, but that you're also going to be getting cuts starting preemptively, you know, in the first part of this year, we think is a bit too optimistic, realistically. But that said, we're still pretty constructive on a lot of the major asset classes, despite a much more bearish macro view on where the US is going to be, but also where Europe is already, and probably where the UK is going to go too. We're pretty bearish.
Okay, Lucy, we also heard from John Williams. So here's John Williams on price inflation.
My base case is that the current restrictive stance in monetary policy will continue to restore balance and bring inflation back to our 2% longer run goal. I'll expect that we will need to maintain a restrictive stance of policy for some time to fully achieve our goals.
So, Lucy, when you have a contrarian view, which actually used to be mainstream 5-6 months ago, yes. Because I guess to get inflation down, the trickier part is always from like maybe 3 to 2% or 3.5 to 2.5%. Does that mean that a lot of other central banks will also be much more cautious? And is that because they worry about the credibility that actually if they don't go for inflation at 2%, it has longer-term consequences?
Yeah, we just think that, what you've seen in terms of some of these easing of conditions at the back end of last year will also feed through. We talked for ages about this lag in the tightening cycle, and we're just sort of seeing that. And now we're going to have a lag in the effective easing that we saw at the back end of the year, essentially. So we just think it's going to take a while to come through. And for a number of these central banks, we just feel that credibility is still an issue, and they really do want to show that they've got inflation under control, and they're not going to want to risk, we don't think, easing too early, and certainly not when so much of the data is still quite strong. So hence our view for the US, that it's going to be really towards the end of the first half before you're going to see a cut. But our view, for example, in the UK is also that, when you do see those cuts, they're going to come much more rapidly, and there's going to be more cuts than the market actually expects. And a similar view for emerging markets, right? We're pretty bullish emerging markets. EM obviously had a pretty good year last year, probably the best year since 19 as an asset class. But in reality, we think those cuts are going to need to come, to a larger degree, and more cuts this year. So hence, for example, we're pretty bullish on EM rates as an example.
So what's your take? I mean, I could listen to you for like ages, going around the world, which we'll also mention the European Central Bank shortly. But what does it mean for equities? So equities versus treasuries, how do you play that?
Yeah, okay. So we obviously had a phenomenal year for lots of asset classes, right, around the world last year. Great year for equities, albeit obviously the S&P, 60% of that phenomenal performance was in the Magnificent Seven. Our view on the US market, for example, is reasonably constructive. We still think you're going to get a good 10% of upside in the US market this year. However, we think you're going to see a broadening out of earnings growth, and we think it's too simplistic just to own big cap, mega cap US names. We think people have to either think about an equal weight S&P or thinking about, the beneficiaries of things like AI beyond just the Magnificent Seven. So we like equities. In particular as well, I would say we think it's also important not just to own the US market. We think there's lots of opportunity in other places. We like the European equity market, for example, relative to the UK. UK's obviously got much more of a defensive tilt within its market. So we see some value in Europe because, again, expectations for growth is pretty low in Europe. So we do see an opportunity there. And we do like a number of emerging market equities as well. And what I would say is the big debate for us is China. So our equity strategist does see quite a bit of upside there. It's a phenomenally cheap market. And of course, managers over the last few years have really cut back their allocation to China. So were that to change, then that could be quite a key market to watch over the course of this next year.
So interesting. Lucy, thank you so much. Lucy Baldwin there from Citigroup. Of course, stays with us. We'll have plenty more insights. We'll talk a little bit more maybe about their play on European equities. Now, 2 Bitcoin ETFs begin trading in U.S. pre-market. This is rather exciting after we've had the trials and tribulations. Okay, it's not doing much, but we did have trials and tribulations after the SEC account got hacked on X, saying that they approved the ETF Bitcoin. Then there were question marks what that meant and when we would get the decision. In the end, they have decided to actually go ahead and give it a stamp of approval, but saying it is not an endorsement. So Bitcoin, for the moment, pretty much flat. This is a grayscale Bitcoin, I think, pre-market. So we'll have plenty more on Bitcoin, what the ETF approval means for the future of crypto investing in general. That's next, and this is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Now, U.S. regulators have finally given long-awaited approval to exchange traded funds investing directly in Bitcoin. Now, the move is seen as a landmark event for the digital asset sector, with industry heavyweights, including BlackRock, Invesco, and Fidelity, given the go-ahead to launch funds. Now, for more, let's bring in Bloomberg senior crypto editor Ana Herrera. Ana, is this exciting? Is this like a watershed moment, or it's just been so, it comes off the back of a really difficult year for Bitcoin?
It does. I mean, it did pick up a difficult period for crypto, I guess, in general, right? But it's hard to see how it's not sort of a big deal. They do, in the end, you have these big giants like BlackRock attaching their name to the asset class. So it's hard to dismiss it. We didn't have the big price pop that people were hoping, though. So I don't know.
But we had it the day before because of the hacking of the account of the SEC.
But it hasn't gone to 50, so we'll see what the next driver will be. It's definitely interesting. I guess the whole point is, will people start allocating now? Will they put money into this now that it's much easier? Will they say, we'll have 1% of this portfolio will be with crypto because it's easier and we trust the issuer?
I mean, even if it's 1%, is this a game? Again, how much? It's a game changer. Right?
It could, yeah. You could have now more mass market investment into crypto. But again, is there appetite? That's the main thing we have to see, right? Like, surely it's gone up a lot compared to where we were a year ago with all those bankruptcies, and it was down to below 20, and now it's back up. And again, it's not dead. Considering everything that happened, it's quite surprising. And we're talking about it, and it's like considered an asset class. So surely it's come a long way.
Yeah, so what I'm still struggling to understand, and I've had a couple of experts come on and say, well, experts, I mean, they're in the space, in saying, well, if they give it the stamp of approval, it means they're happy with the fact that it's a clean asset, right, that they don't see anything too dodgy in it. But the SEC went out of their way in saying it's not an endorsement.
So I think partly it's because, as we know, crypto moves so much on sentiment and social media. It's a thing on its own. And so I think they were very careful to say, we're approving it, but we're not saying you should buy it. And I think maybe it's normal to think that in other asset classes, like if they approve, like an IPO, they're not saying you should buy this IPO. But with Bitcoin, there was so much running on it that they thought, let's be clear that we're saying you can list it, but we're not advising anyone to buy it.
But does it change? Does it mean that they've taken into consideration, that it could go to 0 to 2,000, and that's unlikely, or? What is the judgment on?
I guess the main concern they had was that the price could be manipulated, right? And that there was no way to check, that the exchanges didn't have sufficient controls. And then there was a lawsuit, and it was shown, they were able to demonstrate that actually, the futures and the cash sort of like, the prices are sort of mirroring. So if you've allowed futures ETFs, then you should be allowing cash ETFs. So that was the main point, right? I guess maybe they couldn't fight it off any longer.
Yeah, because it has been quite a long time in the making. Anna, thank you so much. I also got a crash course by Anna this morning on how to find it, because it's not easy to find the futures of this new Bitcoin ETF. Our Bloomberg senior crypto editor, Ana Herrera. Now, let's get back to the markets with Lucy Baldwin, Global Head of Research and Equity Advisor at Citigroup. And Lucy, thank you for sticking around. We really went through, what you're expecting from the Fed, which is a bit of an outlier call. In terms of where you see value, I think European equities is one where you see at the same time, the ECB is trying to maybe accelerate QT. So how do you see that playing out?
Yeah, no, look, I mean, for us, a big theme this year is obviously the geopolitics, right? So you've got half of the world's population going to the polls to vote. So that complexity and uncertainty for us as well means you need that diversification, right? And again, with the equities theme that we're playing, although we're overweight equities in aggregate, what I would say is that, yes, Europe is going to offer one of those main pockets of value because it's obviously a market where expectations are so low. We, like others, do see that easing coming through, particularly in the second half of the year, about 100 bits of cuts from the ECB. We don't really see that there's a major risk of like a double-dip recession in Europe. We actually see that there's some attractiveness there in that market and some stability coming back. I mean, China's going to be a big call really for Europe because of the importance of that market. And I think, again, what happens there in terms of stimulus, how much easing you get coming through and sort of coordinated monetary and fiscal response there is also going to play into Europe. So we like Europe. We see quite a bit of opportunity there. I mean, again, what I'd just say is that, this sort of broad theme of diversification, right? We like government debt pretty much all over the world, right? We like US real rates. We like rates in Europe. We like EM. We think, although they had a good performance last year, we think that can run this year, given that theme of where we are in terms of that cycle, in terms of cutting coming through and the magnitude of some of those cuts. But we also really like equities, and the sort of opposite side of that equation is we're much more cautious credit globally, right? We haven't seen any major weakness coming through in that asset class yet, other than obviously the regional bank wobbles and the REITs wobbles, the real estate wobbles in the US in particular. But most of those areas are sort of recovered now. So we're still pretty cautious. We're watching that closely. But that, in a way, is our recession hedge, along with, of course, the fact that gold is a great recession hedge. And again, we think there's a lot of support for something like gold this next year because you've got the underlying central bank buying support, as well as it having pretty light positioning, Francine.
And Lucy, very quickly, I mean, when you were talking about China, you say this is one of the most important but difficult calls to make.
Yeah.
I mean, are there points in the year that you're looking for to try and understand whether, we even have an economy that's fully reopening, or whether they put enough money to I guess, cushion some of the downfall in property and elsewhere?
Yeah, it's a great question. I mean, we expect China to come out and confirm about a 5% GDP target again for this year. We're broadly there. We're about 4.6% growth for this year, but there's some major unknowns to debate, and how much the new economy segments around tech, advanced manufacturing and modern infrastructure can really pick up the slack of the property sector, because as we know, it's been about a third of GDP, and how quickly those new segments can really pick up the slack is going to be absolutely critical. And issues to watch are things like youth unemployment, which remains incredibly high, and that really is that mismatch in skills, right? You've got a lot of manufacturing jobs that are open, 25, 30 million jobs probably open there, but actually those aren't the jobs that those young people want. And so how that gets managed is important, and I think the messaging, of course, around stimulus is going to be critical. Our view really is that this isn't going to be a sort of consumption-led recovery, and it's going to take a long time before you get consumption levels back to pre-COVID. So this is going to have to be more of an investment-led stabilization/recovery in China as they start to think about that balance between reforms and stimulus, because those reforms coming through is really what's going to be long-term critical to help get investor confidence back in that market, because again, as we know, that's at very, very low levels. So those are some of the things that we're watching for, is the narrative around reforms and stimulus and how that starts to come through this year.
Lucy, thank you so much for joining us today. Lucy Baldwin, they're Global Head of Research and Equity Advisory at Citigroup. Now, coming up, Antony Blinken heads to Egypt for more talks aimed at containing the Israel-Hamas war. This as the International Court of Justice begins hearing a case brought against Israel for its actions in Gaza. More on that next. This is Bloomberg.
think New York is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising
Yeah,
New York
the
City?
mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
The U.S. Secretary of State Antony Blinken travels to Egypt today for more talks aimed at stopping Israel's war against Hamas from escalating into a wider conflict. Now, in the Red Sea, tensions remain high, with the U.S. and its allies weighing options for retaliation against Houthi attacks on merchant ships. Now, this comes as the UN's International Court of Justice begins hearing a case brought by South Africa, which calls on Israel's actions in Gaza to be ruled as genocide. Israel has denied the allegations. Authorities in the Hamas-run territory say at least 22,000 people have been killed since the start of the war. Now, we're joined by Mark Champion, our international affairs columnist for Bloomberg Opinion. Mark, thank you for joining us. And your columns are measured, they give a different point of view, and they're always fantastic. Yesterday, you wrote something saying wars are becoming existential, like it or not. But does this really also go through the problem that the international community and the U.S. have in reining in Israel?
Absolutely. I mean, this is the great difficulty. There is a large disconnect between Israel and its allies on this issue. For the U.S., also for the Arab nations, Saudi Arabia, UAE, etc. In order to win, what they need is to end this war and to find some kind of solution which will satisfy both the Palestinians and so on. That the Saudis have made very clear just recently, the deal that we were going to do with Israel is still on the table, but only if there is a Palestinian state. And yet, within Israel, there's no appetite for that at all. The Palestinians are, also in a kind of existential state. There's 20,000 plus who have been killed. And it's very, very difficult. Once it's a war about you, once the perception is that it's a war about your existence, your future is at stake, it's very difficult to get the kinds of compromises to do, deals that will end the conflict short of some kind of cataclysmic outcome.
So what is Antony Blinken actually trying to achieve? It's frankly sometimes unclear what the U.S. wants. They've shown unwavered support for Israel, but they've also, had more tempered comments.
Yeah, no, absolutely. So, they set out, the U.S. is in a really difficult position. I mean, let's be frank. So, on October the 7th, something, horrific was done. The U.S. came out and said, we have, full support. We need to, deal with the people who did this. But Israel has run with that. You have a government that is actually, not a friend of the Biden administration. This is, not a happy kind of alliance between these particular governments. And it's also the Israeli government. This particular Israeli government is very opposed to any idea of a Palestinian state, has been always. So it's extremely difficult. You know, what Biden's trying to do is to, and Blinken is to get the kind of consensus around, you know, amongst the Arab nations and so on, and with the Israelis, very, very hard to do.
Mark, thank you so much. As always, Mark Champion there from Bloomberg Opinion. Coming up, it's Bloomberg UK. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Good morning, everyone, and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, the economy, financial services, and markets. And I'm Francine Lacqua here in London. Now, on today's show, we discuss one of the longest-running sagas in the UK, involving almost 1,000 people wrongfully convicted of theft from the post office. Now, we also unpack the economic outlook for the year ahead. So can the UK actually dig itself out of a low-growth, low-productivity hole? And what impact will a looming election have on economic policy? Plus, spending big or actually pulling back? We'll find out how Britain's retailers performed over Christmas. But first, the big topic dominating Westminster this week, Britain's post office scandal. has been rumbling on for more than 2 decades. It involves Fujitsu software called Horizon, which inaccurately reported shortfalls in the accounts of British post offices. Now, the post office then prosecuted hundreds of postmasters and postmistresses for theft and false accounting, leading to wrongful imprisonments and even the suicides of some victims. Potential issues with the software were reported on since 2009, yet convictions continued until 2015. And the story has now come back into the public eye due to a new TV drama. In the latest development, the Prime Minister Rishi Sunak announced a law to quash the convictions and speed up compensation to those wrongfully convicted of theft and false accounting.
Mr. Speaker, this is one of the greatest miscarriages of justice in our nation's history. People who worked hard to serve their communities had their lives and their reputations destroyed through absolutely no fault of their own. The victims must get justice and compensation. Sir Win Williams' inquiry is undertaking crucial work to expose what went wrong, and we've paid almost £150 million in compensation to over 2,500 victims. But today I can announce that we will introduce new primary legislation to make sure that those convicted as a result of the Horizon scandal are swiftly exonerated and compensated. We will also introduce a new upfront payment of £75,000 for the vital GLO group of postmasters.
Well, I'm joined now by Bloomberg opinion columnist Adrian Woolridge and our UK business reporter Sabat Medding. So thank you both for joining us. Sabat, this is unbelievable. I mean, you also have people like, from other countries calling and saying what they did a TV drama, and this is why people really are taking notice. Like, what exactly happened?
So it kind of goes back more than 20 years. And if you think in the UK, we've got a massive network of post offices, and sort of out in villages, they were often sort of run by men and women who might have a small shop with a post office counter attached. In the late 1990s, they were all still using paper ledgers. They were sort of filling their accounts each week, and the government decided to upgrade the system. The government obviously owns the post office, with some new software, and Fujitsu won the contract. But the problem was, soon after these new tills were upgraded and installed with very little training, they started noticing that money was missing. Sometimes it was just a few pounds, sometimes it was several thousand. And instead of saying, hold on, there might be something wrong with this software, should we investigate? Right. The post office, which has powers of private prosecution, it can send these people to jail, decided that there was this kind of silent crime wave that this new software had unearthed.
So what actually happened to the money?
The money.
Was it just accounted? I mean, was it accounted in the wrong way, or have we actually found out what was it a software glitch?
There were bugs in the software. So things like, there might be the till would think that you should have £8,000 when really that money was just sort of invented nowhere, and these post office workers would dig into their own savings to fill the gap, and that money's vanished.
And Adrian, you always find the right words in your column, because you start by saying, you can't watch the drama, the TV drama, without having a huge sense of rage.
Yeah,
I mean, this is deeply unfair, because there were also actually calls for a long time. There were whistleblowers and saying, well, this is what happened.
Absolutely. This has been going on for 20 years, more than 20 years. And it's been an extraordinarily large miscarriage of justice. And the most extraordinary thing about it all is you have a question. Do you think that these discrepancies in the accounts are the result of a computer going wrong? There have been many, many examples of computer systems going wrong. Or do you think it's the result of a sudden outbreak of criminality among these salt-of-the-earth type of people who run local post offices? And the post office came to the conclusion it must be the people to blame. Now, that is an extraordinary conclusion to come to, and to stick to year after year after year.
So who's to blame, actually? In this, I mean, it's amazing that after that, Fujitsu still won other contracts. Have they apologized? What would they do differently now?
Ultimately, the senior management is to blame. To some extent, the government is to blame. And to some extent, Fujitsu is to blame. We don't know exactly what was going on, but the management took a line that the post workers were to blame, that lies were told. These post workers phoned up the helpline and said, something's going wrong. And they were told over and over again that you're the only person who's discovered this discrepancy. There's no other examples of that. That was a direct lie. And Paula Bennells, the woman who was CEO during these crucial years of the post office, has returned her CBE, is widely held to be accountable. I think should be held to be accountable. But I think we need to ask a lot more questions about Fujitsu.
And so this is what we picked, I mean, from your column, actually, which I think also really goes through, the crux of it is basically, you write, the British Post Office scandal is at root a story of how people at the top would rather trust systems and numbers than regular people. I mean, will that change? Again, is there a concern about how the government structure is in the UK, or is it more of a human error, like a human problem?
I think it's a systemic problem with the way that management works. There's a tradition in management that goes back at least to Frederick Taylor, the inventor of scientific management, who says that don't trust the people, trust the systems. The way to improve productivity is to use numbers, use slide rules, use objectives, and force people to perform according to sticks and carrots. That's very deeply rooted in the sort of the psychology of managers. It's been reinforced by the consulting boom, the outsourcing boom, reinforced by the MBA boom, and my big worry is it's about to be reinforced massively by AI. People, who do you trust? The systems or the people? I think managers tend to trust the systems, and with AI, which has this sort of glamour of being scientific and up to date and the rest of it, will lead them to trust the systems even more. So I think that this is a systemic, not just a British problem.
Saba, what do you think happens next now? So the Prime Minister apologised.
What happens next? I mean, there will be this mass exoneration, but really I think that lots of these people, I mean, if you were sort of one of the 555 who, if you remember, took this to the High Court and they won in 2019, they're still waiting 4 years later. Lots of the money, they won 43 million, but most of it got swallowed up by legal costs. They've only been offered 75,000 as an interim payment, and they've still got to fight their case if they actually want to sort of be put back in the position where they would have been. And let's not forget, lots of these people are elderly. They don't have the means to hire expensive lawyers to continue fighting their case. So I think hopefully what happens next is they get some kind of peace and are finally kind of, all these years later, they're still seen as criminals. So hopefully they manage to get what they deserve.
Adrian, do you think this is it's an election issue? I mean, again, it just goes there's a rift between how people view government, which is widely in their minds incompetent.
It's become an issue, and it's quite extraordinary the number of politicians who, having ignored this issue for the last 20 years, have suddenly said, I care about this more than anything else in the world, and are competing with each other to wear their hearts on their sleeves for the poor postal commissioners, for workers. But I think there is an interesting political angle here, that one of the people who seems to be complicit in ignoring it is the leader of the Liberal Democrats, called Sir Ed Davey, who was Office Minister in 2010 and didn't meet with the relevant people. And he is the Liberal Democrats are a big threat to the Conservative Party. And they're a threat because they challenge the Conservative Party in its heartland seats down in the south of England. And the Tory Party will do everything it can to put the blame as much as possible on him. And it may dent his reputation as a sort of decent crusading character.
Thank you both for joining us. UK business reporter Saba Meddings and Bloomberg opinion columnist Adrian Woolridge stays with us. Now, coming up, the Bank of England governor plays down concerns about the effects of higher interest rates. So we'll focus on the UK economy next. This is Bloomberg.
The tag on the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
This is Bloomberg.
our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology. And welcome to Balance of Power.
This is Bloomberg.
Increase in unemployment. We've had seen very little increase in unemployment. That's relevant because historically one of the drivers, and if you sort of analyse it sort of statistically, one of the drivers of loan losses, particularly in the mortgage market, is unemployment. And the second one is associated with that certainly last year we saw actually an increase in around about a 2% increase in household real incomes. Both of those things support, obviously, overall conditions and financial stability.
Well, that was the Bank of England Governor Andrew Bailey speaking to the Treasury Select Committee yesterday. Now, still with me, Bloomberg Opinions, Adrian Woolridge. We're also joined by Bloomberg's John Stepek with his newsletter, Money Distilled. Distill Our Money. I feel like 2024 is going to be eventful because of the election, and we still have to see exactly if the Bank of England cuts and how many cuts.
Yeah, I mean, you've summed it up very nicely.
There you go. Bye-bye, everyone.
Yes. I think the main things we're coming into 2024 in a slightly better mood and certainly in a much better position than we came into in 2023. At the start of last year, everyone was kind of thinking we were already in recession, worried about a big house price crash. None of that's happened. As Andrew Bailey was actually just saying there, a lot of that is because unemployment has stayed low. Inflation has come back down probably faster, and certainly faster than the Bank of England had expected. Next month's reading, December's reading is likely to come in at below 4% again. And so really just it's all about the kind of recession that never happened. Or, I mean, we might still get a technical recession, but it's not going to be a big deal if we do. So really, I suppose we're looking at a better outlook for the UK economy as long as it's not derailed by some sort of external event, which
but John,
can always happen.
It's also election year, right? So the likelihood of the government not throwing everything at this economy is I guess, fairly small.
Yeah, I mean, that's true. The one thing is that, on the other hand, I can't see, kind of the Chancellor coming up in March and saying, well, let's throw fiscal caution to the winds, because obviously they're still paranoid about what happened back in October 2022 when the gilts market imploded. And everyone, I think, including the Labour Party, is keenly aware of that. Yeah. But yeah, definitely, I mean, I think we can expect some stimulus, some sort of tax cuts. Just but moderate ones.
Yeah. What are you expecting, Adrian? I mean, it's kind of a confluence of a bit of everything, right? It's monetary policy, but then there's, cost of living, which plays into the election, and it just seems a bit like a mess.
A mess.
Technical term.
A mess. I think that the outlook now is not as bad, not as dismal as it was at this time last year.
Yeah.
So things are looking a bit better, inflation coming down, cost of living pressures not being quite as bad. But I have two big worries, and they're both politically related. One is that we overstimulate the economy. There's too much, loosening, and the bond markets get nervous. And I think the tolerance of the bond markets for poor economic management in Britain is a lot lower now than it was before Liz Truss came and made a complete mess of things. So that is my big worry on the British side. But my big worry on the global side is that we get a Donald Trump presidency, an election. I think that will create a huge degree of uncertainty, nervousness, and send big shocks through the global economy. And in Britain, as a relatively weak, fragile economy, might well suffer from that. So things getting a bit better, big problems potentially ahead.
So, Adrian, and we're hearing, and this is all hearsay for the moment, that, you know, the Europeans are, and I guess also British officials are trying to fill a space to have more of a weight if there is President Trump back in the White House, and also, you know, dealing with China, because we're kind of stuck in the middle.
Absolutely.
What would that look like?
Well, I think that's true, but there is a big problem with Europe as well, and that is that the populist surge is also likely to affect Europe, that we could get some big increases in populist parties in the European Parliament, in Germany, in Italy, and particularly in France. So again, that will create a lot of nervousness, and it will distract the attention of the Europeans away from managing the global economy. Just what on earth do we do? So it's politics really that is generating the uncertainties and what looks like a small recovery for Britain.
John, we did a podcast actually yesterday with also the Eurasia head on his top 10 risks that are out today. And number one, he did have the U.S. versus itself, so the U.S. election. What does smart money do if Trump becomes president? It's unclear. I mean, a lot of it is domestic stress.
Yeah.
But what does it mean for stocks?
Well, you see, this is the kind of problem. It's, you know, the last time that Trump got elected, I remember the day, you know, futures collapsed, and then by the end of the day, markets were up. And that's the problem with trying to make predictions about investments based on political outcomes, because we just don't know. You know, Trump might come back, and he might end up being similar to last time, you know, actually not as bad as expected. I mean, I think that's a low possibility outcome, I have to say. I do think if he does get back in, it won't be great. But short of, you know, owning some gold in your portfolio, I'm not really sure how you hedge those kinds of risks. The one thing I would say is that the fact that the US is suddenly under scrutiny, Europe's under scrutiny, and the UK is actually having a competition between two guys who are not that different, right, makes us look somewhat more attractive than we have for the last wee while.
I'd add something to that, that if we do get a Trump presidency, I think it won't be like the last Trump presidency. It'll be much more hardline, much more organised, and much more dangerous for the global economy. But there is a possibility of Britain actually doing quite well out of this, because there will be civil disorder in the United States. There will be a very hardline Trump presidency if he wins, and that will mean that a lot of people, you know, mobile money might say, well, I don't want to be in New York, I'd rather be in London. You know, so it would be good if Keir Starmer, who will probably be the Prime Minister by then, plays it well. That could be a way of attracting a lot of nervous Americans over here.
We could speak another 2 hours for this. We'll have to get you both back on Bloomberg Opinions. Adrian Woolridge, thank you so much for joining us, and we'll be hearing more from John Stepek in a moment. Coming up, strong Christmas results from Tesco and M&S. We'll be discussing the outlook for UK retailers. That's next, and this is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this, and what the Fed does potentially?
This is so exhausting, and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Now, two of Britain's biggest retailers have reported strong Christmas sales as shoppers at Tesco and M&S splash out on food. Still with us, Bloomberg Opinions' John Stepek. We're also joined by our UK correspondent, Lizzie Burden. So, Lizzie, good morning. Talk us through some of the market reaction. M&S down, Tesco up.
Yeah, well, we already knew that it was a strong Christmas for the retailers. We had that BRC data, the Kantar data, and so the market reaction is more about expectations management today. You had Sainsbury's yesterday not increasing its profit guidance. M&S hasn't either, and so investors have, it seems, seen that as a bit of a signal of caution, actually, even though they did well in sales for food, they did well in sales for home and clothing as well. And then when you look at Tesco, actually they did upgrade their profit guidance, but still the market reaction is muted, and that again seems to be just like with M&S because they had such a good year last year.
So can you actually break it down? People have bought more food because they want to treat their family and friends over Christmas, but maybe less gifts.
Well, yeah, you are seeing for all of the retailers, food is the thing that people have been prioritising through this cost of living crisis. They're not spending so much on extra goods, non-essentials. If they are spending on things other than the necessities of food and housing costs and heating, it tends to be experiences. And if you look specifically at M&S, actually they're in the middle of this turnaround, right? So you've got the CEO and the chairman, Archie Norman, essentially trying to get customers to do their weekly shop at M&S, not usually what people do, and also to convince customers that their clothes are high quality and they are fashionable. So it seems to be going pretty well.
And this kind of, I mean, I like looking at retail, especially at Christmas, because it's such an important period, but it kind of really shows the strength or the weakness of some of what the UK economy has seen or will see.
Yeah, I mean, I think that it's very hard to make the bearish case for the UK consumer, you know, from these results and the results we've had so far. It shows that people have still got money in their pockets. Yeah. It probably shows that real wages going up is starting to help. You know, energy prices have come down, house prices have held up miraculously, and mortgage rates, although they're still a lot higher than they were a year ago, or well, actually 18 months ago, are kind of coming back down from the peaks. I mean, you can now get a 5-year fixed rate mortgage for under 4%. At one point that was above 6%. So people will probably be panicking a bit less, even if they do have to refinance this year. So basically, I mean, overall, it feels like it's pretty healthy. And really all that's happened with the share prices, as Lizzie says, is that the market kind of already expected this. And so you're getting a bit of a come. I mean, Marks & Spencer's was the second best performing stock in the FTSE 100 last year. Yeah. You know, more than doubled. So, you know, coming off 4% today is not exactly that big a deal.
So, John, at the same time, the Sir Howard Davies, the NatWest chair, got in a lot of trouble for saying that it was fine or it was easy to get a mortgage. Like, can you update us on how mortgages have come down? I don't know whether the tests are as hard as they used to be.
Well, basically, the problem, I mean, obviously Howard Davies was extremely tone deaf, and it is hard to get a mortgage relative to what it was prior to 2008, for example, you know, because you could get 125% mortgages at that point. Problem is, that's one of the reasons why we had such a tough time in 2008. Since then, bank rules have been tightened, and the problem is that house prices have gone up a lot, so it's very hard to kind of raise a deposit. And now that mortgage rates have gone up, you know, from, you know, kind of 2% to 4%, it's also much harder to make the monthly payments, and therefore you can't borrow as much. So housing transactions collapsed rather than prices last year. I mean, as long as real wages keep going up, and house prices don't suddenly take off this year because sentiment changes, then maybe it'll start to get easier. But yeah, I mean, it was a daft thing to say. It's easy to say stupid things on telly in the spur of the moment. I hope that never happens here. But yeah, so it's not easy to get a mortgage or buy a house here.
Yeah, Liz, the other thing we're watching is Boohoo. Now, this is not really about consumer. I mean, this is more specific to Boohoo, but it's down quite significantly.
Yeah, Boohoo for Boohoo. It's paired some of the earlier losses, of course, on the AIM. It was down about 6.6% earlier. And this is because the BBC had a panorama investigation where they showed that Boohoo had been putting made in the UK labels on clothes that were made in Asia. And it's not the first time, is it? We had Boohoo kind of surrounded by alleged scandal 3 years ago. They had to change their ethical practices. And so after this, they've said it was a human error, it was an isolated incident. They're taking steps to rectify the situation. But yeah, not a happy morning for Boohoo.
Yeah, thank you both for joining us. So Bloomberg, Lizzie Burden and John Stepek there with his newsletter, Money Distilled. Now be sure also to subscribe to Bloomberg's In the City podcast that I host with David Merritt and Allegra Stratton on Apple Podcasts, Spotify, or wherever you get your podcast. This episode today is with Ian Bremmer of Eurasia. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth the 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this, put it over here.
Not cool. Not cool. All right, I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Good morning from our world headquarters in New York. I'm Menace Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Crypto's big breakthroughs. Bitcoin spot ETFs, they're finally getting the green light from the SEC a decade after that first proposal. John Williams says rates are high enough to cool inflation to the Fed's goal as investors gear up for the U.S. CPI. That hits the slate today. And the tech industry's cutbacks extend into 2024. Google joins Amazon in announcing significant layoffs. The equity market this morning is front-running a lighter CPI print. They are ignoring the narrative from John Williams. That is the New York Fed, after all, and he's making it very, very clear that higher for longer is his narrative. So we're seeking validation in the CPI numbers today. And of course, you have this moment of where JP Morgan are talking about deeper cuts of 150 basis points. Danny will take you through that in a moment. But what is the beatification of an ETF do? You're going to keep an eye. The Nasdaq's up by 0.3%. Coinbase is in that. So a lot of these exchanges are going to see this inflow. They're all the ETF providers. They're just slashing and burning on fees. They're going for the jugular. I love that line about BlackRock. So when it comes to market share, spur nobody and grab everything would be the edict either on the desk. Nasdaq is up a third of 1%. Citi, by the way, say they favor growth stocks and they want to lean into value. They obviously listen to Danny as well. The Topix is at a triple decade high for the 6th day in a row. It's autos and techs on tech stocks where you saw the flow show go in there. Go for the jugular, Danny. That's BlackRock.
Every day I feel like I should just leave for like the buy side. I feel like you're crediting me for all these calls. But again, I do not offer investment advice. Let me just put that out there again. Manus, I mean, you went through this wonderfully. We finally got the spot Bitcoin ETF approval. So sorry, we have to talk about it for at least one more day. Weirdly, there wasn't a ton of alpha to be had if you correctly guess this. I guess because the world saw it coming. Here around 4:30 p.m. New York is when we got approval. We spike up and then we trail back lower. Kind of awkwardly, it actually spiked higher on that fake tweet about an ETF approval. So there we go. Bitcoin at 46,000. 11 issuers can now offer a spot Bitcoin ETF today. We're going to be talking to one of them later in the program. That's Wisdom Tree. But Bloomberg Intelligence says that assets could reach $30 billion in just today, in just one day. Meanwhile, U.S. 10-year yields, those come down about 3 basis points. We await the CPI report today. Will a CPI report support what JP Morgan says, that 150 basis points are coming for this market, for this Fed? The market is right. The Fed is, I guess, essentially wrong, if that's what they're saying, but they say the front end will benefit from that. Finally, Brent crude, this is also moving higher this morning, up nearly 2%. The spike coming after a headline that an oil tanker has been hijacked in Oman carrying illicit Iranian crude. So this further links some of the turmoil in the Middle Eastern waters to Iran and the U.S. directly. So geopolitics, man, is certainly one of the risks we talk about, but the other one is about supply, bond market supply. And on this, things have been going off wonderfully. Europe so far, even the data just through Wednesday, so not even a whole week, it has been a record week for Europe. $118 billion worth of bonds being sold. No supply indigestion to be seen.
No, none at all. And the 10-year auction went pretty fine last night as well. 37 billion. I say last night, yesterday afternoon. 37 billion went off the slate. Very easy. Here in the U.S., the investment grade issuance hit $37 billion. Now, that's nowhere near what you got in Europe, but certainly there is an appetite for that higher quality duration. And that is what is surprising. How much more supply will come before we get these moments of indigestion. Danny.
Yeah, so we have that supply auction today, and of course, we also have the CPI print today. Stock futures, you pointed this out, Manus, they are maybe front-running it, running a little bit higher. But here's a quote from Man Group's Ed Cole on how he's thinking about the Fed as it relates to markets right now, that the Fed's dovish shift in December has reasserted the normal reaction function that markets have become accustomed to and indeed seem to viscerally crave. The Fed put. Ever the poet, Ed joins us now. I love that. Viscerally crave, Ed. I mean, last time you joined us, you were, shall we say, a kind of selective bear. You didn't like the overall market, but there were selective things you liked. Have you changed to an all-out bull now if the Fed put is back?
Well, I was just wrong, wasn't I? Which is
That's humble of you.
Which is what was the case for most of 2023 when it came to calling beta. It was a hard year. Luckily, we're in the alpha business, not the beta business. Look, I think it's still a very tricky outlook, right? I think the Fed is signaling that assuming inflation continues in the trajectory it's going, which is probably a fair assumption, but there could be some sand in the gears along the way, that they will be starting to think more about worrying about the other side of their mandate, which is employment and markets by extension, and worrying a bit less about the risk of breaching inflation on the upside. So that's a good thing for markets. I think what it doesn't take away is the risk still on the cycle. And if JP Morgan are telling us you're going to have 150 basis points of cuts, you're not going to have that unless the economy really needs it, right? That would be the Fed responding to the employment part of the reaction function, the employment part of the mandate. And they're only going to do that if they believe that things are really much worse than the market currently discounts today. So we sit here today talking about the US, as we always do, on a big multiple, on record high earnings expectations, on record high margin expectations, on an assumption that disinflation is going to happen beautifully, on an assumption there's going to be a soft landing. There's many things that have to go right there, and not a lot discounted today that could go wrong. So tricky again.
Ed, good morning. You're one of the most robustly honest people I think we've ever had on this show, which is to say maybe, for the moment. Now, look, you line up, it's like a pinball there. You line up the things that have got to immaculately go beautifully, and one of those is disinflation. As you look at those series of risks, which do you think we are just blithely assuming is going to happen, but there's a real risk that it could be torn apart? Where do you think the crack in that pinball wall is?
Still the cycle for me. Still the cycle. I mean, timing cycles is hard, right? I think we all know that. Typically, you're early, which is as good as being wrong. But the reality is that we're sitting here today with so many things lined up that historically have pointed to substantial slowdowns in economic momentum. If we're going to avoid that, we're going to really have to rip up everything that's happened historically in pretty much every cycle post-war. One of my colleagues did a fantastic analysis recently that showed that you've never had a period of such pronounced contraction in the ISM manufacturing and the ISM new orders without a recession since, I think, 1948. Never happened. So maybe it doesn't happen, but we have to assume that everything that's happened before is now irrelevant in this cycle. I guess the way I think about that is what was so surprising in 2023 was the resilience to demand because of that unexpected boost to savings from COVID that lasted so much longer than anyone expected. It's gone now, right? So now we're assuming something else happens that we can't forecast. Maybe that is the lesson of 2023 is, keep worrying about the things that you couldn't forecast.
Well, one of the more technical things that also changed, I mean, we had 2 decades of a pretty steady negative bond equity correlation, and with inflation that flipped to positive. Is that something that also remains?
Well, I think this might be a year where we see it go back to negative. I think that if you think about what's taken the long end from 5 to 4, it's been the assumption that inflation's beaten, which is probably a fair assumption, and that's good for everything. But if you go from 4 to 3, it's a bit like what I said about JP Morgan's call on the front end. If you're going lower still, you're kind of assuming you're having to price that something is getting worse in the long run about nominal growth expectations. Now, maybe that's just inflation totally normalizing, but that's still a bold call with where services inflation is today. So my guess is if you're going from 4 to 3 in 10 years, you're doing that because the data's looking quite weak. And if the data's looking quite weak, then it's bonds bid and equities possibly offered. That doesn't need to be a catastrophe, but it possibly is a world where stock-bond correlation turns negative again. I don't know how long it lasts. Probably a world where risk parity does quite well.
Because that's been getting hammered. Yeah. Manis, jump in here.
I mean, the debate is going to be whether you're getting rate cuts for disinflation or rate cuts for recession. We just won't know that, Ed. And I like what you said, being early means you're wrong. Where are you with term premium? I mean, given the various scenarios that you outline, consistently below 0. But then the line here is an anomaly which needs to rectify itself at some point. So what is your view on that? Is it that we suddenly, Danny and I talk, we started this show with talking about easy demand for bonds, investment grade at home in Europe and here in the US. But do we suddenly flip over to deficits and supply? Is that what shifts the term premium?
Term premium's hard. And I'm an equity guy, so I'm gonna try and dodge it as much as I can. I guess, look, when we looked at term premium in the fourth quarter, it was remarkable how quickly it went from quite negative to quite positive, and without knowing what the right number is, just the pace of the move kind of suggested that had moved far enough. It was one of the fastest sort of 50 basis points rise in term premium I think we could spot. And now it's gone back to negative again. I guess we could be in a world where at some point we're exiting potentially that period of abnormal central bank intervention, which is one of the reasons potentially that term premium was so depressed for such a long period of time.
Let me throw you an easy bone then to close off in 30 seconds. Out of your global equities, where do you want to be longer, here in the US or the rest of the world? Because it doesn't sound as if you're that bearish. You might have been slightly off kilter, but where's your call as we go forward now?
Still bearish, still wouldn't really want to be particularly long equities this year, rest of the world versus US.
Grant, there you go. He wrapped it up in 15 seconds.
Stick to your call.
And thank you very much. You make me feel bad now throwing you a term premium question on an equity. You're capable of everything at Man Group, I've heard. Okay, Ed Cole there on the markets. Let's take a look at some of the other stories trending on the terminal this morning. Morgan Stanley has elevated 155 employees to managing director. That's a smaller number of promotions to the firm's top rank than last year. Sources tell Bloomberg that women account for 37% of the promotions.
Bloomberg has learned that Citadel has emerged as the only global bidder for Credit Suisse's securities venture in China. Sources say the firm put in a bid in the range of 1.5 billion to 2 billion yuan. Credit Suisse has been seeking around 2 billion.
And speaking of Citadel, Danny, Ken Griffin, Blackstone's Steve Schwartzman, and Elliot's Paul Singer are among the donors who collectively gave $18 million to Super Political Action Committee supporting David McCormick, the former Bridgewater CEO, in a Republican running for Senate in Pennsylvania. Coming up, we'll continue the political conversation. Nikki Haley and Ron DeSantis battle it out in Iowa for a final time before the caucus. We discuss the highlights. That's next. Danny.
And in the hour, you know what we got to discuss. It's been 10 years in the making, but the SEC has finally approved all 11 Bitcoin spot ETFs. We'll be speaking to one of the companies who got that approval. It is Wisdom Tree. We'll be speaking with Christopher Ganetti on the historic decision here on Bloomberg Brief.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology. the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. With the island emerging as a flashpoint between the U.S. and China, Taiwan's presidential election is drawing global attention. Bloomberg is live from Taipei as the future of Taiwan is decided. Coverage begins this week and continues Monday on Bloomberg.
If he can't handle the financial parts of a campaign, how's he going to handle the economy when it comes to the White House?
Under her administration, you would have seniors getting less cost of living adjustments while your tax dollars are going to pay the pensions of Ukrainian bureaucrats.
That's not true.
You talk about
That's
putting
such a
Americans
lie,
last.
Ron.
That is wrong. You've supported all that money going over there. So let's put
You're
our
so
own people
desperate.
first. We
You're
have
just
to put
so desperate.
Presidential candidates Ron DeSantis, Nikki Haley taking chunks out of one another, trading insults across the debate in Iowa. And it is the last one before the caucuses. Joining us now is Bloomberg's Kate Ackley. I mean, one could say what were the main takeaways, but I mean, there's just a vehement dislike between the two candidates for one another. It was visceral, wasn't it? But what was the main takeaway?
Yeah, they're both. I think it was described as feisty. A lot of back and forth, a lot of digs. It sort of sets the tone going into the caucuses in Iowa on Monday, being, kind of jabs at each other, with yet again, the leading contender not being on the stage. Donald Trump was off on a different network, Fox News, talking, doing kind of a town hall with a friendly audience. So just a real contrast yet again. And another of the sort of maybe most important developments yesterday also didn't happen on the debate stage. It was former Governor Chris Christie dropping out.
And on that, I mean, this is just like the most awkward thing I could imagine of a lead up to your announcement if you're going to drop out on a race, that Chris Christie was caught on a hot mic talking to someone called Wayne, talking about Nikki Haley, saying she's going to get smoked. Excuse me. You and I both know she's not up for this. So Chris Christie is saying that. I mean, is the assumption, though, even though Trump wasn't up on that stage, that it's Trump for 2024, that regardless of the headway Nikki Haley's making, that's the outcome?
That's certainly the most likely outcome at this point, based on the polling. Obviously, once you have the caucuses, you'll have a real poll. Then you'll have New Hampshire, and then heading into South Carolina, we'll know a lot more then. Obviously Nikki Haley seems to have the best shot at taking Trump down so far based on the polls, but it's a long shot for sure.
Did either of them show their hand or talk about it? I mean, we've got some big issues on Capitol Hill. We've got a shutdown, we've got funding for Israel and Ukraine and the war. Did either of them show any directionality on those? Because they are hot button topics as well, at least at the start of the year.
Between Nikki Haley and Ron DeSantis, there's a little bit of difference when it comes to funding for Ukraine. And we see Ron DeSantis aligned a little bit more with the hardline Republicans in the House. Nikki Haley's has a more of a mainstream Republican view in support of that funding for Ukraine's war against Russia. So I think you see a little contrast there for sure. On Israel, you get the sense from their sparring last night, they both want to be the most supportive of Israel. So they're both pretty much aligned there in terms of supporting Israel.
Okay, Kate, thank you very much for that. That is Kate Ackley of Bloomberg Government. Of course, tune in for special coverage of the Iowa caucus. That will be on Monday starting at 8 p.m. Eastern. A quick check on your bond market. 10-year yields just below 4%. We're gearing up for CPI day. Positioning has shown that long positions are starting to build. Investors are no longer fighting the Fed's dovish pivot. Can it last? JP Morgan sees 150 basis points coming. UK 10-year yields dropping by about 3.5 basis points. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
It's Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Manus, I think it was yesterday Piper Sandler said to us that the Mag 7 were going to turn into the Lag 7. Well, tough times for employees of some of those Mag 7. Amazon, we learned yesterday, is cutting hundreds of jobs in their Prime Video and Studio service. They already had rolling layoffs in 2022 and 2023 that axed 27,000 employees, and it just seems like it's all part of cutting back on costs that had ballooned during the pandemic.
Yeah, and I mean, look, tech went through a sort of a bleed on jobs last year, and many people sort of said they were at the front end of the job cuts, and so they were in better shape going into 2024. Google, also, they're the owner of Alphabet, up 1.85%. They're cutting hundreds of jobs in hardware, and it's an assistance unit. So last year they said they cut 12,000 jobs. That was 6% of the workforce. So you've got employees there on the edge. And I think the question is this as well, Danny, if you're going to have mega mergers, like you just look at what was announced, Juniper and Hewlett-Packard, that $14 billion merger, what is that going to do to the jobs market within tech and mobility and work from home and all of those other aspects, are so prescient in tech?
And one of the other themes here is it just jobs going to AI, to automation? Manus, is literally your worst nightmare come to pass. Duolingo let off about 10% of its contractors, and they specifically said part of that could be attributed to AI, that they're replacing people with the bots. I know that this is what keeps you up at night, Manus.
I'm just waiting to see the hologram version of me and just see whether it gets confused when the camera doesn't work, when the headlines are dropped, when you don't have any paper and you're looking at the camera and you're just praying that something good is going to happen, and you go, yes, it is. Look, the camera works, and there's the prompt. Whereas a robot, I'm sure, would have none of those emotions and be completely and utterly phlegmatic and deliver the headlines with all of that.
But maybe
not that that ever happened to me ever in my career at Bloomberg. None of that.
Never.
So I'm not
Never. No, my dream is you get the hologram up and running, and then we're just off on a beach somewhere. Manus, kind of related to, I guess, traveling from that, there's this other story that caught our eye about passports. Yeah, every year you get a list of the most powerful passports. Europe has joined the ranks of the best passports. Before, Japan and Singapore were on the top, but now also joining Japan and Singapore are France, Germany, Italy, and Spain. If you live in any of those countries, you get to go to 194 countries visa-free. Sadly, nor Manus nor me have a passport to any of those places.
No, I have an Irish passport and I have a lapsed British passport. For some people where I come from, that's absolute heresy. But the British passport, which I have got to state officially has lapsed, that is number 4. And I'm a long way from getting a US passport, Danny. There you go. Very long way.
I have both.
You've got
I have both, but what does it get me? I mean, the UK one is good, right? It gets its fourth place here. The
it
US
just
one?
adds to your whole regal air. You know,
yes,
you just,
it's
you
true.
just, you
but
just
get
want...
the tiara out.
Eh?
Get the tiara out. You know, I'm ready for that. The U.S.
You can
Manifesto
steady up on the
7th.
tiara. There's only room for one tiara on this show. Have a look at Bitcoin. What's going on?
All right, Bitcoin prices are up about 1%. We're going to be speaking to Wisdom Tree about this shortly, about the Bitcoin ETF approval. They're one of them to get it.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Welcome back to Bloomberg Brief. I'm Manus Crenny in New York.
And I'm Danny Berger in London. Here's what you need to know. Crypto's big breakthrough, Bitcoin spot ETFs finally get the green light from the SEC a decade after the first proposal. New York Fed President John Williams says rates are high enough to cool inflation to the Fed's goal as investors gear up for a key U.S. CPI data due today. And the tech industry's cutbacks extend into the new year. Google joins Amazon in announcing significant layoffs. Well, it finally happened. We finally got the Bitcoin ETF approval. Bitcoin up about 1 1/3%. It did spike up more than this, about 47,000 when we got the initial approval, and then it went back down. So maybe not a ton of alpha in foreseeing this approval because literally everybody did. But Bloomberg Intelligence says that $30 billion worth of flows could come into Bitcoin ETFs. Again, 11 were approved to start trading today. We're going to talk to one of those approvees in just a few moments' time. 10-year yields. Those dropped by about 4 basis points. We're under 3.99%. We've been stuck in a close range around 4%. What will the CPI data do to that today? JP Morgan saying that 150 basis points is fair for cuts from the Fed, and that means you want to be buying the front end. Finally, Brent crude moving higher by about 1.7%, undoing some of the losses yesterday. This has to do with an oil tanker being hijacked off the coast of Oman. Again, it's those geopolitical concerns that this represents potentially economy, not necessarily, but potentially another escalation threat and a war risk premium, which has yet to be priced into oil. Manis.
Yeah, and that's a consistent message. So if we do get the 150 basis point cut that JP Morgan are talking about, and they want to buy the belly of the curve, it's interesting, Ed Cole, who is just with us there now, from Man Group on the equity side, if you get 150 basis points of cuts, that's something much more malevolent and negative, and could put pressure on stocks and give the 60-40 portfolio a good breath of life. Stocks are up by an eighth of 1% this morning at 48.26. So it's what kind of rate cuts do you get? Are they recession rate cuts? Or are they disinflation rate cuts? Either way, the CPI numbers, this equity market is really trying to sort of front run good news on the CPI. Traders are buying $9 million worth of regional bank ETFs as a hedge out there. So there is a little bit of hedging going into the bank reporting. The NASDAQ is up at 31%. Keep an eye on Coinbase along with the other exchanges on the back of that Bitcoin news. Bitcoin at 46,500. That's good news for all of those exchanges out there. The question is, who is going to go for the jugular? And I saw a lovely quote that it is BlackRock is going to go for the jugular in terms of cutting fees and bringing in the volume, own the space, own the sort of the dominance. That is going to be the key as to what you choose and who you choose to go to for your ETF. NASDAQ at 17,002. The Topix is up again. We're blowing through this multiple decade highs, and it is tech and autos in Japan that are driving that. We're up for the 6th day in a row. This is the close, up 1.5%. Danny.
Manis, what you mentioned about Ed Cole from Man Group's call, I think one of the more fascinating things about it is what it means for portfolio construction, because for the past 2 decades, we've seen stocks and bonds be negatively correlated. With the focus on inflation, that's flipped to positive. But he says when the fear moves away from inflation to growth, yet again, the correlation will be negative. So that means things like, you mentioned this, Manis, 60-40 or even risk parity, they can start working again. It's been a tough run for them, but finally bonds will act as a hedge to any sort of falling equity market.
Yeah, but where does the hedge take you to on the bond yields? That's probably the question as well. If there's something more malevolent going on in terms of an economic slowdown, do bonds trade to 3.5%, or as some guests have said to us, down to 3% on a real protective trade? But let's just reflect on what investors are awaiting. They're trying to catch the indication for the Fed's next policy move, either in the data, the US CPI data coming in just under 4 hours' time. Let's take a listen to what the New York Fed President, John Williams, had to say yesterday.
My base case is that the current restrictive stance in monetary policy will continue to restore balance and bring inflation back to our 2% longer run goal. I'll expect that we will need to maintain a restrictive stance of policy for some time to fully achieve our goals.
Okay, Callum Pickering listened to that as well, senior economist at Berenberg Bank. Callum, thank you for joining us. So the market seems to have heard one thing, which is a validation of peak rates, but it's simply ignored the higher for longer narrative. That was my take. Yours, good morning.
Well, when we say monetary policy needs to remain restrictive, that does not necessarily mean that rates need to stay exactly where they are now. I think one way to think about this is, let's ask the question what the neutral rate in the US is. If the neutral rate is 4% on the funds rate, then the Fed can take out 150 basis points and simply be putting monetary policy in a neutral gear. And until you get to that point, there will still be some restrictive element in there.
Well, part of that also gets to how much more do they have to go to squeeze inflation out, and that was apparent in the minutes, the debate in there of how much of the easy inflation is gone, how much of the supply chain and energy prices, again, all of that being squeezed out of this inflation picture. How much do you think is left? Is there any easy inflation to get rid of?
I actually think the Fed is basically there. One way to think about this is we have these big shocks last year and the year before to prices, and so we have to abstract a bit from these annual changes. If you just look at the level of prices in the US, whether that's just the normal CPI measure or even the PCE, which is the Fed's preferred, the price level has basically been moving sideways or just edging up a bit for about 6 months. If I look at the 6-month annualized on both measures of core, we're at the 2% target. So I think if the Fed really needed to cut in a hurry, I don't think it will, it could probably justify it based on where inflation has been. And last year was almost as good as it gets in real life for a central bank. Nominal GDP slowed, real GDP accelerated. Heading into this year, I think the Fed will probably want to ease a little bit just to prevent that slowdown in real GDP turning into a potential recession.
So the base case then for you is disinflation, good, constructive, healthy rate cuts for no malevolent reason. With that in mind then, what does that do to the bond market, and does that embolden a pro-risk stance for equities?
Yeah, that's our base case is we get 100 basis points in cuts this year. I know the market's close to 150, and I think we see the first cut in May. But I think the risks are finally balanced. I think there is a risk that we end up with more cuts than that and a little bit earlier, because we find out at the beginning of the year that the US is heading into recession. There are a few warning signs. The inverted yield curve, credit delinquencies, expectations for non-residential investment. We need to pay close attention to this. Unfortunately, the problem with monetary policy is you often find out after the fact that you've done a little bit too much. And so I think it's sensible for the Fed to be validating market expectations for cuts at this point, because what we're seeing in forward curves is rate expectations coming down. That does take the sting out of tight monetary policy. And as for bonds, I think there's a lot of uncertainty this year. I think fair value is probably around 4.5 on a 10-year, but I think we could be 100 basis points lower than we are now in case we find out we're in a recession. We could also be 50 basis points higher if we just get the soft landing and then the acceleration into the second half of the year.
It's certainly a range there, but you say the first cut is May, possibly earlier. How soon then does the Fed need to start slowing down their balance sheet unwind?
I don't think central banks actually need to be worrying at this stage about their balance sheets, right? If they think that there's enough liquidity in the bond market, this can be happening. I mean, the Bank of England has a different way to put it, but it can happen in the background, right? Let's draw the market's attention to the primary policy tool, which is the funds rate. And there's sufficient headroom to cut aggressively from conventionally normal levels, so that even if you think that there would still be a bit of tightening going on in the background because of what you're doing with your balance sheet, actually you may just prefer to let that keep running, bring the balance sheet down, and just take 50 extra basis points off the front end if you need to.
But, I mean, in the US, there is this split between William's view and Logan's view on where we are with that balance sheet, with that QT narrative. If they reduce QT, even margin, I mean, does it depend on the scale of the reduction of QT or the timing of it? What is more important for the market to understand?
Probably the signal will be the thing that moves the market in the first instance, and then, of course, the bond market has to figure out what the balance of demand and supply is. This is the reason why I actually don't like QT as the description. I much prefer quantitative reversal, because I think QT implies that there's a lot of tightening going on through the central bank channel. Actually, the major determinant of bond yields from a demand and supply dynamic is just the issuance from governments. I think that, for me, is the more important thing. And so I think if the Fed were to frame it the right way, I don't think that they would have to announce much of a slowdown. And if they do announce a little bit of a slowdown, probably, if they get it right, it shouldn't really affect the path of short-run rates either.
We're going to have to start calling it QR to people. I think that might confuse a couple people, but we can just cite you and be like, watch this interview back, you'll understand it.
Exactly, because there is a moment where you might want to tighten through balance sheet, in which case, what do you call it, QT star?
Yeah.
QT light.
Please no more stars, Callum. Yeah, QT light. Callum, before we let you go, so you have the CPI print today. I mean, in total, we have 3 more before March. What sort of thing would you need to see from the prints to solidify a cut that the market is pricing in March?
I think you would need to see a material slowdown well below 2% on an annualized basis. And I think you would need to see, say, the warning sign from the employment services ISM, which looked pretty rough in the last month, translate into genuine and sudden losses in the labor market. As long as the labor market is holding up okay, as long as domestic demand seems to be moving mostly sideways, I don't think the Fed will be encouraged to go as early as March. If we see obvious signs of a recession, then March becomes real.
Okay, Callum, thank you so much for joining. And also here, congratulations might be in order. Yeah. A paternity leave at the end of the week.
That's right. Number 2 comes this weekend with any luck.
Congratulations. I hope you enjoyed what little sleep you have now going forward. Callum, thanks so much. That's Berenberg's Callum Pickering. All right, Manus, a quick check on currencies. Look, they're not doing a whole lot. They have to wait for the data today. The Bloomberg dollar spot is a little bit weaker. Sterling the dreaded unched, and let's be honest, euro versus the dollar is little change too. So, Manus, we wait and see what happens later today.
Yeah, well, the equity market seems to have got itself all geared up. I mean, we've wiped out this year's losses. Maybe we are all gravely mistaken. Maybe it was just a little bit of a momentary drive-by, and we've got to re-rate risk. But one thing that is coming up, it's over the speculation, the waiting for the spot Bitcoin ETF. It has been approved. Christopher Gennati from Wisdom Tree joins us. They are part of the story and delivery of ETFs.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
I'm delighted that we're at the end of this saga. I know there's still pieces of it to go, but I think this is a big milestone.
SEC Commissioner Hester Peirce speaking after the approval of all 11 spot Bitcoin ETFs. Bitcoin is climbing, but let's be honest, I mean, it's not doing anything crazy, but that is in response to the approval of those 11 ETFs. One of those to be approved was Wisdom Tree's ETF. Joining us now is Christopher Gennati, Global Head of Research at Wisdom Tree. Chris, thanks so much for joining us. Congratulations to you and the team for making this. One of the things we're trying to understand is what this means for Bitcoin as a whole. Is the approval for you just a revolution in the ease of people owning Bitcoin, or is it a change, a step change in the core proposition of Bitcoin?
So what we think, and we're very excited to be here today and to be part of this first wave of initial spot launches in the U.S. at Wisdom Tree. You look at it and you say anything that increases the investor base, increases the number of users, makes it easier for people of all types, whether from the smallest investors to the largest institutions, to buy in. This is going to be a net positive. And it's interesting that you see various developments at the country level. I know El Salvador a few years ago, Argentina was making noise earlier this year. So you've kind of got two sides of it. You've got the investment side, and then you've got certain countries around the world who really benefit from something like Bitcoin and the use cases it brings.
Christopher, good morning. It's Manus in New York. Everybody's trying to understand the grab for market share. You're right there. You're going to compete with the other new entrants. There is a line that BlackRock is going to go for the juggler in terms of fees. Now, you are going to offer 0.3% for the first 6 months. They're going to be waived on the first $1 billion. How robust will the fees be? Do you think you'll be able to have that level, 0.3%, or is it going to be an aggressive commoditization of fees from the start?
I mean, I think today we see an aggressive commoditization of fees from the start, multiple providers waiving whatever fee they had in the books to zero. So the actual investors are essentially paying zero for whatever period of time, and those periods of time can, of course, be variable. Maybe the waivers continue on. You just don't know at this stage. But I think what's historic, and WisdomTree, it was competitive when we launched floating rate treasury back in 2014, and the government had created that new asset class. But essentially, that asset class was an exciting ETF launch that just went out into the ether because the interest rates were zero. It didn't matter yet. This is something totally different where you get the sense there's pent-up demand. Clients want this. It's coming off of incredibly strong returns and performance last year. And we'll have to see where the market goes.
So Chris, though, how does one set themselves apart? How does WisdomTree, for example, get more assets than ARK, which is essentially doing the same thing, waiving the fee for the first 6 months, but then ARK is even settling at lower fee structure of 21 basis points. How does WisdomTree stand out in the crowd?
So the big thing at WisdomTree is we've been in the game globally going all the way back prior to 2019. There's a robust product set in the European market, almost 500 million in assets if we look at it today. So you've got that global experience of speaking to investors that leads you to be able to put together different types of research pieces, different types of ideas. You've obviously got to leverage what you can from the different relationships, but I think you hit the nail on the head of an important point in the sense that if we're all providing exposure to spot Bitcoin, the differences that you're able to bring to bear are going to be very slim provider to provider.
There's a whole world for you to market to and to convert, to put a portion of their wealth into the Bitcoin ETF. It certainly will give people more confidence because there is a regulator, et cetera. I'm just curious, to what extent will WisdomTree market to the savings and retirements market? I mean, Gemini had a line on this, is that 36.7 trillion of savings in retirement and cash. Are you comfortable? Are you going to market, aggressively market, and win market share from the retirement and savings community?
This could be an initial step, and at WisdomTree, one of the things we do is we basically say, if you use your data sources, you put together a global market portfolio looking at all different types of assets, and you say, how much would Bitcoin or digital assets represent if you basically said you've got your real estate, your bonds, your equities, and it's around 1%. So then you basically step back and you say, could a large swath of all different types of investors, pensioners, retirement investors, all those different types. Now, there are still boxes to tick. It may not necessarily be an accessible vehicle in every retirement plan today, but this essentially regulatory approval, we think, is the first step on that journey. And over time, a small percentage for a wide range of investors
Chris,
could be interesting.
Even though they got this approval, I mean, Gary Gensler is kind of doing the opposite of endorsing it. In his statement yesterday, he said that though we're merit neutral, I'd note that the underlying assets in metal ETPs have industrial uses, while in contrast, Bitcoin is primarily a speculative, volatile asset that's used for illicit activity, including ransomware, money laundering, sanction evasion, and terrorist financing. Chris, can I just get your reaction to that?
It's a strong statement for sure, and ultimately I always step back to the fact that everything as a society we have come up with has been used for both a positive and a negative. The U.S. dollar is certainly used in its share of not so great types of transactions. And in the different markets around the world, we think the Bitcoin use case is different. If you're in a market where you're doing a lot of remittances, the value that you can bring using something like this is a lot higher than if you're sitting, say, in the US, as I am, and you're able to just send money to your family via Zelle, because that's an interesting solution on the traditional means. So depending where you're sitting in the world, it could influence how you see the value proposition of something like Bitcoin.
But let's be frank, Gensler says he does not approve or endorse Bitcoin. This is going to be a continuing uncomfortable relationship with the regulator. He's going into battle with you.
Well, we're gonna do what we can to play within the rules of the game and follow the rules of the road. But you're absolutely right. It's not the same endorsement as you might get for a vanilla equity or bond ETF.
Okay, we wish you well, Christopher. Good luck out there. Win your market share. At Christopher Gannatti there at Wisdom Tree on day one of the crypto ETFs. And we will have the CEO of Grayscale on the network a little bit later on. That's 1 p.m. Eastern Time, 6 p.m. London. Tune in for that conversation.
Let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Bloomberg Brief, Danny Berger in London, Manish Cranny in New York. All right, let's get you set up for your trading day this Thursday. Here's a look at what's ahead. We're going to have the latest read on U.S. inflation, 8:30 a.m. Eastern. That's the big one. We're also going to have initial jobless claims at the same time. Then Cleveland Fed President Loretta Mester will be on Bloomberg TV at 11:40. We're also going to hear from the Richmond Fed Tom Barkin at 12:40. Then $21 billion of 30-year Treasury bonds go on auction later in the session. That's today. Man, it's tomorrow. We have the bank earnings, and already Citi under a little bit of pressure with the pre-warning.
They are. I mean, this came late yesterday afternoon after the market closed. They're going to take, set aside, I should say, $1.3 billion. Now, this covers their exposure to Argentina and to Russia. And you spotted this, Danny. The stock is down 1.2%. But there's also a charge in there, Danny, for the big structural overhaul that Jane Fraser is delivering, $780 million on the overhaul.
Yeah, but we're going to hear from Citi. We're going to hear their results tomorrow. Mike Mayo, he likes Citi with or without Jane Fraser. He does love Citi. It's his ¡1 call. Of course, JP Morgan just floating around those all-time highs.
Yeah, I mean, Mike thinks it's going to triple in value. He's obviously worshipping at the altar of Jane Fraser and the turnaround. A metamorphosis, I think, is the word. Yields dropped, Danny, ahead of this U.S. CPI. And then, of course, you're going to need the PCE to, I suppose, ratify any of this. But there you go. 30-year auction tonight, Danny. The 10-year went fine last night. 3.99, sub 4%. That's not bad for stocks.
Not too bad, but Callum Pickering says that the next 3 CPI prints need to come in sub 2% to validate the market's bet of a cut in March. We'll see how those figures turn out. Surveillance is up ahead.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
We still think the market can move higher in 2024.
I think this is a fairly decent nominal growth environment.
We do think that there is a chance that there will be upside surprises in the economy.
The U.S. economy might actually re-accelerate over the coming quarters.
We should be celebrating that this economy is quite good.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Your equity market on the S&P 500 just about positive. The main event, 8:30 Eastern Time. TK, it is drumroll. CPI Thursday.
Yeah, we're here. We're here, and then on to the banking tomorrow. I'm going to conflate them all together in a moment, but to get specific, John, about 8:30 and CPI, how important is the next day in PPI that nobody's talking about, where you get a disinflationary trend of what the public's doing, core the headline, but also what businesses are doing with PPI.
And the data point neither of us have just discussed, which is jobless claims, which comes out later on this morning. And Tom, jobless claims, 202, previous read, 210. The estimate today. That is historically incredibly low to see claims still down here.
I'm going to give you the statistic from the Ohio State, and that's Columbus, Ohio. Unemployment rate 2.80%. How is that stress? I mean, it's fully employed America to a lot of people. And John, that rolls right over to a market with a bid yesterday, ex-Boeing, and a further bid today as well. That's a complete bit dog bid.
And a little sprinkle of Fed speak in between. We'll talk about bit dog.
Can you see how I look different?
A little bit later. What have you done?
I've been put on a list of Bitcoin idiots.
Have you? Yes. Is that an official list?
I guess it's a list.
Who is running that list?
On behalf of Senator Warren of the Commonwealth of Massachusetts.
Oh, Senator Warren's running it?
Oh, yeah. No, she's on the list.
Oh, she's on it?
Yeah.
Okay.
Somebody's running the list.
Is she above you or below you?
Oh, she's way above me.
Way above you. That's good to know. That's good to know as well. Sprinkle of Fed speak in between today, not just about the economic data. We'll catch up with Loretta Mester later. I'll give you the time of that in just a moment. I want to reflect on what we heard from John Williams, the New York Fed president, yesterday afternoon. Tom, I expect that we will need to maintain a restrictive stance of policy for some time to fully achieve our goals. The Fed on repeat.
I want to synthesize this in, John, and we'll do this all through the show today, and folks, you're going to see this with us tomorrow as well. Mark Cabana with the blistering first great research note of 2024. Cabana of Bank of America conflates Powell, Mester, all the challenges they have, into what Jamie Dimon's going to tell us on Friday, and it all redounds and synthesizes from the Fed, the big banks, down to the tensions of our small banks in America. The Mark Cabana note, hugely sophisticated on reverse repo, is there's a real tension out there beneath all the headlines Thursday, Friday.
It's a fascinating finish to this week, going into the weekend. A few more days to go. Let's get to the price action. The scores look like this on the S&P 500. Positive here by 0.1%. Yields come in 3 or 4 basis points. The 10-year still in and around 3.99. In the FX market, the euro doing absolutely nothing once again. 109.69. That currency pair pretty stable, almost unchanged. Negative here by 0.02%. Here's the calendar. Here's the next day or so. Coming up a little bit later, here's your morning brief. CPI 8:30 Eastern Time alongside jobless claims. Look out for all of that. Then the Fed speak today. Loretta Mester with Michael McKee coming up on Bloomberg TV and Bloomberg Radio. A conversation, Tom, you do not want to miss later on today.
I don't think McKee knows the questions to ask until he sees CPI at 8:30. That will change the dynamic, the discussion with Mester of Cleveland.
Makes that Fed speak just a little bit more valuable, Tom, today, as opposed to yesterday, so they can respond to the information that comes out later.
Bramall's not here, so this, it's clearly.
Do you want to get to the bank
Should
earnings?
we have an auction today?
Tomorrow. We won't talk auctions, we'll talk bank stocks. Bank earnings tomorrow, JP Morgan, Bank of America, Citi, Wells Fargo, all of that still to come. The standout picture on that board, Tom, and you've said it a few times, just to see B of A over the last 12 months down by something like 2%, and JP Morgan up by 22%.
Right.
One of those is not like all the rest, and it's JP Morgan, which has just outperformed beautifully in the last 12 months.
It's Sesame Street banks tomorrow. And, John, what I would say is when in doubt, they're going to do what they do, which is job cuts. And I'm really interested, not so much in the conference calls, but in the next 2-3 weeks to see how they rationalize forward.
BlackRock set the tone for that earlier this week.
Absolutely. And it wasn't 2 or 3%, it was more.
TK, do you want to bring in our next guest? They won a wonderful prize. A wonderful prize.
Yeah, let me explain this, and this is honor Fred Wiegold, who was just magnificent at Bloomberg. He invented the Wall Street Journal Beauty Contest on what you do on the street, and all of that led off of institutional investor and what they do in polling and trying to figure out who makes the fewest mistakes across a given year. Christopher Verone was strategist. He does technical analysis and macro strategy, and he joins us this morning after adding a trophy to the mantle at home as well. Did you have a cigar with Jason Trenner?
Oh, we did, yeah.
We did. And I'm sure it was one that a better cigar than you would have had with me. Let's talk about the why of this. What do you need to do in X's and O's, point and figure, exponential moving averages. How in God's name do you win a trophy in technical analysis?
Listen, I think our approach is very simple every day. We simply try to put provocative charts and ideas in front of people. The goal is always to be as correct as often, but the reality is you're never any more right or wrong than anyone else, but are you pragmatic or dogmatic? And we really try to be pragmatic in our thinking.
You're on trend analysis, and I am. Chris and I, folks, theoretically are on the same page versus something called stochastic analysis. Torsten Slok, who doesn't believe in your smoke and mirrors, came out with a memo yesterday at Apollo and said the variance, the standard deviation of all the forecasts and stuff John, Lisa, and I talk about every day, never has he seen this variance. Do you see that variance in your technical analysis?
Well, I think what we've seen certainly over the course of the last year is a lot of the correlations and rules that a lot of people have built their careers on were either ineffective or didn't work or on delay. And that's where I think there's value in trend following and prices and momentum, because it allows you to forget about the things that don't make sense and instead focus on what the tone of the tape is, and the trend here has been up. So we kind of evaluate things from the standpoint of what's the status quo. Status quo is the trend is up, and what could upset that? What do we have to be on guard for that would change the perception of the status quo?
Let's talk about the banks going into earnings tomorrow. How are the banks performing?
Technically, they act great. I mean, we're talking about 85% of financials are in an uptrend. That's one of the better readings we've seen in the sector in probably 2 or 3 years now. I think importantly, when you go group by group within financials, something we always do, what does the consensus perceive to be the weakest corner of the market? And then we evaluate, is it actually acting as the weakest corner of the market? And for a long time, small cap financials or small regional banks, community banks have been perceived to be the weakest corner of the market. They act great here, John. So it's hard to say the market really reflects that anxiety. You could do the same thing in REITs right now, right? When you travel around, what do you hear? Oh, it's Manhattan office that's very weak, or it's West Coast office. Well, look at the office stocks. They actually trade really well. So we can be worried about those things intellectually, but does the market allow for you to position in that direction? That's the bridge that my work is trying to cross.
Well, let's introduce the tension cross-asset. Yeah. Is the Treasury market supportive of what you're suggesting will happen and looking to happen in bank stocks? Just that stability we've seen, even the 10-year yield just sort of hanging out around 4% now at 3.99.
You know what I think is pretty interesting, John? The yields peaked, I think, October 27th at, call it 502. They come down to 370, 380. As they move, as they make that move lower, a lot of the speculative stuff works. A lot of the financials work. Things like biotech work. The last 2 or 3 weeks, if yields have crept back up to 402, the same stuff has persisted. So it seems like the market's actually moving away from being so obsessed with what every tick in bond yields is. My case on yields is we probably bounce into 430, 440 here, and then we can evaluate. I'm in the steeper, curve steeper camp. I think we're losing twos, particularly as we move through Europe. But generally speaking, 430, let's reassess what the call intent should be.
I'm going to suggest Dorsey Wright really invented modern relative strength analysis. Folks, this was a Bible. You'd get it printed out. This is back when we used quill and dipped it in the ink. And the answer is Dorsey Wright basically invented this. And the cardinal rule is you can go short if the market's short, the sector's short, and then you find a stock to go short. That ain't happening right now. How do people go short, bet negative in an up market with selected up sectors as well?
Well, I think your best chance for shorts right now are relative shorts, not absolute shorts. And the way you describe it, Tom, is absolutely right. If you're going to be short, you need the market helping you. There's an old saying you're only a good short seller basically by luck if the market's helping you. And when you go stock by stock or sector by sector right now, if you're going to look for relative shorts, it's still probably consumer staples here, right? They're the weakest relative performers. You could say there's still stuff in energy or basic materials, which are relative lows. But most of the sectors that we really spend a lot of our time trafficking in, discretionary or industrial, still pretty firm.
So bring it over to Magnificent Seven. I'm a big believer that Magnificent Seven are each individual stock stories, each individual charts. But what is their technical construction now, given the carnage of Jan 2, 3, 4, whatever, and the huge bounce back of the last number of days?
Well, I think the way you phrased that, Tom, is important to kind of frame our thinking. Last year, this was a very monolithic group. And our kind of thinking on Mag 7 this year is it's not a monolithic group. And you're already beginning to see that here a little bit. So Apple, as we know, the most important stock in the world, has not necessarily been involved the last few weeks as the others have. I have Microsoft at new highs, NVIDIA at new highs, Apple has lagged. So there's a bit of a shift there. I think it's the first clue on that front.
The earnings profile of Apple compared to, say, NVIDIA is very, very, very different. Your thoughts on Apple going into the new year? I believe we get earnings in early February, start of the year with 2 downgrades, Barclays, Piper Sandler. Your thoughts on the performance of that stock, the multiple expansion we saw, and the iPhone almost going ex-growth, in fact, going ex-growth over the last 12 months?
So I'll let the smart people worry about the fundamentals on why something may or may not be happening, but I'll frame it like this. The low in Apple in October was 167, right? Stock trades, let's call it mid-180s right now. If the tone of the market's going to change, it probably happens with Apple below the October lows. I'm very big on this idea of every year start with reference points, right? Under what levels would the status quo for the market begin to change? As the market's most important stock, I think quietly, if Apple gave up 170 on the downside, you would say, okay, that's a meaningful change. That is new information relative to what we've seen over the last year.
TK, Apple closing yesterday at 186.19.
It's a raging battle, but my recollection is we had the same raging battle, John, 90 days ago. I don't think it's, obviously it's a different story. But
no, you're absolutely right, Tom. The things we're saying about Apple today, you could have said 90 days ago, and the stock performed beautifully through the year, up something like 48%.
You know, John, if there's a difference here, if you look at Apple relative S&P, it's actually undercut its October relative performance lows. So again, it's the first of this kind of Magnificent Seven group that has actually seen some legitimate relative deterioration. So I don't think it can be owned in the same size as maybe 6 months ago.
Interesting. Chris, this was great. It's good to see you. Congratulations to you.
Thank you. Appreciate that.
Thank you, sir. Chris Ferrone of Strategas, a bad company. TK, great start to this morning. CPI coming up a little bit later. We're going to talk to Skylar Montgomery-Koenig of TS Lombard. We'll do that at 7 a.m. Eastern time, so in the next hour. We need to talk politics as well, Tom. We're going to speak to John Lieber, I believe, of Eurasia Group shortly.
It's going to be interesting. Iowa upon us. It's on Monday, Martin Luther King Day. And, John, you'll be traveling to Davos. I think Iowa will be most interesting. Michael Shepard and our team in Washington really giving us good coverage on that. But then it's on to New Hampshire. And after the debates last night, I just have no idea. I'm worn out by the back and forth juvenalia. I can't process it.
Do you want to teach Governor Christie about hot mics?
Somehow there'll be another. Yeah, somehow there'll be another lesson. That John Farrell.
A lot of people criticize Governor Christie over the hot mic, but it happens, TK. When you get comfortable having a microphone on your lapel, it can happen. But it happened yesterday, and he had some things to say about Nikki Haley and Ron DeSantis. To turn around and tell someone that Nikki Haley's going to get smoked, to talk about your ROI of what you've spent on advertising and the return you've got for that. I mean, pretty revealing comments.
Yes, but it's vintage Chris Christie.
Sure.
He's sort of been doing this for decades,
I just love finding out what people actually think about a certain situation. Never mind like the varnish of sitting there in front of people when the news conference goes live and you say the things you think you've got to say. I'm interested in the things that people actually think, and I think we got just a little snippet of that.
Did you get your orders in for 930 Bitcoin and you slide into an ETF?
I didn't. Did you?
I saw you in a conference call. He's on a conference call, folks, an hour ago with Kathy.
I was on a call, that's true. But not with Kathy.
Kathy, what do you think?
Equity futures on the S&P 500, just about positive, up by 0.1%. Chris, thanks for joining us. Good to see you. The 10-year, 3.99 from New York City. This is Bloomberg. City.
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
We don't need another mealy-mouthed politician who just tells you what she thinks you want to hear just to try to get your vote.
He has switched his policies multiple times, and we'll call that out tonight. But every time he lies, Drake University, don't turn this into a drinking game because you will be overserved by the end of the night.
When you need someone standing and fight for you, don't look for Nikki Haley. You won't be able to find her if you had a search warrant.
How did you blow through $150 million in your campaign and you were down in the polls?
So here's
you are not a manager. No, now I'm going to say.
I think it's very instructive about what how Nikki
this,
Haley sees the world.
I think I have the floor.
GOP presidential candidates Ron DeSantis, Nikki Haley sparring on the CNN debate stage yesterday. The two Republicans calling each other liars, exchanging insults throughout the evening. All this, TK, ahead of Iowa on Monday.
Yeah, we had a drinking game at the Keene household last night. Every time I was fed up with this debate.
Zeitgeist.
Every time that was just, I'm sorry, irresponsible. I am so worn out by the childishness of this. It's painful. There's no other way to put it.
As a practical matter, we're down to 2, Tom.
Is there any
you imagine
equivalent of
after
that in the
Monday we
United
go down to
Kingdom?
1? Yeah, Parliament every single week.
Okay.
To be fair, I've got to say, Tom, I wish I saw more of that in Congress. In
Fair.
Washington,
Yes,
D.C.
I agree.
I'd like to see a robust exchange of views. You don't want to see the slang in, the insults, slinging insults either side, Tom. But ultimately, you want a fiery debate, of course.
Emery Horton, she's going to be with us in the next hour?
Later this morning,
Her people said she can make it. That's good. Emery Horton to be with us in the next hour. Right now, we get a brief, an informed brief from John Lieber, Managing Director of United States at Eurasia Group. Of course, they're out with their top risks and far more. His work for the gentleman from Kentucky, and there is only one gentleman from Kentucky years ago. John, I look at this, and I'm going to dismiss DeSantis just because that's what the numbers tell me to do. Is Haley running for vice president?
That's a great question. She would be a very good vice president. She's right out of central casting for President Trump. She's got great foreign policy experience. We heard that last night. Her views on Ukraine are well-informed. They're forceful. It's the part of her campaign that's most compelling. The challenge is that I don't think Trump likes her all that much. And, if you look about Donald Trump's motivations, he tends to be motivated by either somebody out of central casting, which Haley is. She matches up really well against Kamala Harris. But he's also seems to be motivated out of spite. And unless Haley starts saying some really nice things about him soon, I think that he's going to look elsewhere.
And for those of you on radio, John Lieber, the only reason we have him on, he's got this absolutely cool banjo in the background. Let's go to Bill Keith and your Kentucky deliverance that's out there from movies long ago. Are the Republicans going to get deliverance in New Hampshire? Is New Hampshire going to change the dialogue?
I think Trump looks pretty good in New Hampshire. With Christie out, this is where Haley has a shot to consolidate the field. But Iowa still matters. I mean, if DeSantis is a close second in Iowa, which I don't think he will be, then there's a chance that he could rally some of his voters and make a deeper push into the spring. What's more likely to happen is that DeSantis is a distant second or maybe even third in Iowa, and then it's Haley's race to lose in New Hampshire next to DeSantis. But Trump is still the dominant force. He's way up. He's going to blow everybody out in Nevada. He's going to blow everybody out in Michigan. And he's probably going to win South Carolina. And it's going to be really hard for either of these two to consolidate the field if they don't win a single state before Super Tuesday. So this is now still and has always been Trump's race to lose.
The working assumption is it will be the president, the former president, Donald Trump, who will be the candidate. John, we've seen the approach from the current president, President Biden. His approach seems to be, it's me or it's democracy under threat. It's him or it's democracy. And John, I just wonder, how successful do you think that approach is going to be on the national stage?
Well, look, the debate last night got all the attention, but I think the main show was actually on Fox, where Donald Trump was giving a town hall, and he was pretty good. He was funny, he's charming, he showed command, he showed leadership. I think that's going to contrast really poorly with President Biden, who's, there's no other nice way to say it, he's getting up there. And, whatever Biden says about Trump, Biden's got to run a very negative campaign against Trump in order to have a shot here. And he's got to convince voters that, ignore the inflation, ignore the wars overseas. This guy is terrible, and I'm here to remind you of why. I think that's a really, really difficult argument to make in an environment where your popularity is in the high 30s and people don't feel good about the direction of the country.
John, I'd go one step further.
Here.
I'd say he's got to actually run a campaign because he didn't need to last time around. We were in the pandemic. He could sit back, make it a referendum on the sitting president. He won. How different will this campaign be compared to what we saw back in 2020?
Yeah, that's a great point, John. I mean, I think that it is an unusual presidential campaign where you're having two ex-presidents, a current sitting president and an ex-president running against each other. You could credibly try to make this a referendum on Trump, but you've got to remind voters what they didn't like about Trump in the first time. And Biden is just not a vigorous, forceful campaigner that can really make that case. He's going to have to do it through proxies, and he's got a lot of baggage. So it's a big challenge.
To your service with Senator McConnell in the nation, what should the senator from Kentucky say to Nikki Haley? I mean, they're comrades in arms, north and south, if you will. What does Mitch McConnell say to Haley to prosecute the best path over the next number of months, say to Super Tuesday?
I think he says, good luck. Make sure you got enough money to spend on ads and make sure your ground game is really good because that's the only way you're going to have a shot at beating Trump. The big thing is going to be money, right? You've got to keep the donors motivated. You've got to make them believe that you have a real shot here so that you can prosecute this campaign.
It doesn't matter how Haley polls against Biden. That just is not part of this discussion.
It's not what's motivating voters. I mean, you just don't see primary voters in the U.S. acting strategically. If you did, you'd have a much more vigorous challenge against Biden in the Democratic Party, and you'd have people, thinking about looking ahead to the general election in the Republican Party, but you don't. And people are motivated by their emotions. People are motivated by the guy they like and the guy they think is fighting for them, and that guy is Donald Trump right now.
John, the world is watching. You've put out the top risks earlier this week. Number one, it's pretty original, although probably widely expected. It's the US versus itself. Now, John, as you know and have explained over the last few days together with the team at Eurasia, this is going to have huge consequences on several fronts around the world, including in Ukraine and what's developing right now in the Middle East as well. John, when you speak to clients at the moment, especially the international clients, what are they talking to you about? What are the questions they're asking about this election this year? And ultimately, what are you telling them?
Yeah, our international clients are acutely aware of the U.S. election. They followed extremely closely, and I'm always impressed and a little dismayed at how much knowledge they have about the U.S. political system because, they got better things to do with their time than pay attention to the Electoral College or what reconciliation is. But our international clients are quite concerned about the return of Donald Trump. One of the things that's always highlighted to me is whether or not the U.S. is a reliable partner for the rest of the globe. The U.S. led the security coalition in favor of Ukraine. It's planning to lead, it's positioning itself to lead a security coalition to defend Taiwan. It's Israel's biggest backer globally, which of course isn't all that popular in the rest of the world. But can the U.S. be relied on when you have deep partisan divisions that mean the policy pendulum swings violently back and forth depending on who wins the White House? This is a huge question on top of mind for a lot of our clients, particularly our European clients, who are very worried about future President Trump's commitment to NATO and the shield of protection that provides for them.
John, let's go there. Let's talk about the Europeans. Maybe we can reframe things. Have the Europeans proven they can be reliable partners to the United States on certain issues? And I'm thinking specifically of China.
That's a great question. The Europeans are acting very mercantilist in their commercial interests when they're thinking about China. The U.S. has been a leader on this front. The Chinese use economic coercion to their great benefit and have been doing so in Europe. And you look at, Germany last year, Scholz sent over a coalition of German industrialists to China in order to deepen their trade ties with China. But I don't think this is the number one issue in Europe right now. I think Russia is the number one issue, and it is for the U.S. and it is for the Europeans as well. And this is an issue that they're very freaked out about. They see the threat that Russia poses on their border, and they need the U.S. to help them defend it. And if the U.S. isn't there, it's going to drastically change the balance of power in Europe in a way that we haven't seen for almost 100 years.
Super thoughtful stuff. Appreciate your time this morning, John. Let's catch up again soon. John, leave it there of Eurasia Group. TK on the election still to come in 2024, the domestic story and the international consequences.
Going to get my takeaway there, other than the really interesting questions you had, John, and like how Europe perceives this, is ever more the primaries are polarized. I mean, if there was a legitimate Democratic primary this year, I think it'd be exactly the same. You've got it with RFK Jr., but the bottom line is the primaries are highly polarized versus where we're going to be the third week of October into that November election.
Equities on the S&P 500 positive here by 0.1%. It is CPI Thursday. That means we're going to catch up with Julia Coronado of Macro Policy Perspectives. That conversation up next.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Equities up on the week, up on the session in the equity market right now on the S&P 500. Just a little bit higher, positive by 0.1%. The Nasdaq, Tom, up by 0.4.
You know, I'm like Ace Greenberg. I got the buy and sell tickets on the left and the right, and I'm trying to get the buy ticket out for that first odd lot purchase of Apple, and I just can't pull the trigger. You know,
just sticking in cash.
Well, you look at January 2nd, 3rd, the world's come to it. And remember, like a weekend long ago, deep into 2024,
I wouldn't go
world's
that
come to an
far,
end.
but yes, people were questioning what could go wrong, and
It's
things have
over.
started to
It's
go
done.
right again. Equities are up. We're grinding closer and closer back towards all-time highs. In the bond market, just some stability on a 10-year, contributing maybe to that better tone, better sentiment in the equity market. 4 straight days, I think we've closed above 4%. We're a little bit lower this morning by 4 basis points, 398.28, Tom, on a 10-year.
Real yield 1.76%. I'm watching it carefully. I think there's a raging debate as it centers around the inflation adjusted yield, and you know, maybe we'll get a lot more information here at 8:31.
The 10-year is basically where it was after the Fed meeting in the middle of December.
Program note, Ed Yardeni publishing late last night makes real clear with a gallon of gas and other used cars, rents. Yardeni wonders, okay, here's survey, and maybe we just come in light given these, particularly rents.
Well, let's get to that. Under surveillance this morning, your top story, US CPI. That data is a little under 2 hours away. The median estimate in our survey expecting a 3.8% read on core inflation, down from a month ago. New York Fed President John Williams saying, quote, "My base case is that the current restrictive stance of monetary policy will continue to restore balance and bring inflation back to our 2% longer run goal." Tom, as you know, politics, headlines, newspapers might focus on year over year. I think the consumer's still feeling the cumulative inflation since 2020. Wall Street focused on month over month and the more shorter-term trends and what they inform the Federal Reserve about the future.
John Williams and his former mentor Bill Dudley at the New York Fed, Bloomberg opinion columnist, will look at some form of annualized statistics. I'm going to go with Jason Furman. I'm sure we'll see this morning out of Harvard, where he takes a matrix or sum of different annualized calculations. And that's sort of where I'm going to be. And the answer is 2-ish, 2.2-ish, 2.3-ish, and that's awful near-ish where John Williams wants to get.
This is a clinic.
It's a clinic.
This is good. We'll get an actual clinic.
Julia Coronado's going to step
Coronado
up and walk
in just
away
a moment.
from the mic.
Stay tuned for that. I want to bring you an update on Boeing. A quick return to the skies unlikely for the MAX 9 jets. Transportation Secretary Pete Buttigieg not offering any timeline, telling reporters, quote, "The only consideration is safety. That's going to dictate everything. Nobody can or should be rushed in that process." Alaska Airlines have already cancelled all flights on the MAX 9, Tom, through Saturday.
We had a new FAA guy come in, Mike Whitaker, I think's his name. We featured him on Bloomberg Radio yesterday, Paul Sweeney and I. What did Buttigieg and the new head of the FAA do? Alaska Air is going to look at what, 14 Boeing 737s? What if they find one with loose rivets?
I know.
I don't really see where this is going, other than a bad outcome for the nation.
So Jeffrey suggested that maybe we could get this plane back in the sky over the next week. I think the Transportation Secretary is tempering some of those expectations just a little bit based on those comments. Let's bring you the roundup from Iowa just quickly. Insults flying on the debate stage yesterday evening. Republican candidates Nikki Haley, Ron DeSantis squaring off ahead of Monday's caucus, repeatedly accusing the other of lying. The favorite for the Republican domination, Donald Trump, skipping the debate, instead hosting his own town hall. Counter-programming, Tom, on Fox News last night.
The former president has been brilliant on this. He's just not going to participate. And I really wonder, forgetting about Trump and Biden at their August age, is this a new trend where heavyweights within any campaign say, we're just not going to do the childish back and forth?
I think it's a strategic decision to say, look, I'm the former president. I'm not participating in the primary in the way that you are. I don't need to. I've got a massive lead. You're struggling to catch up. What's in it for him? Why participate?
John, have you ever seen the video of John F. Kennedy and Richard Nixon, 1960?
Yes.
That, we don't want to get back to that. That's just too nostalgic. But there was just a grace to it, as Kennedy said, "I'm the young one," and Nixon struggled. And that's what the nation wants to see. They want to see the vitality.
Can you imagine
people are not one-liners.
The two individuals that are front runners for this race talking about who was the young one on stage and how that would go down?
In black and white, maybe you'd want to put it in black and white and make it more theatrical.
Should we get to our next guest?
Let's get to our next guest. Julia Coronado joins right now, founder, president, Macro Policy Perspectives. My head's spinning over debates. Let's talk about the debate at the Fed with Dr. Coronado right now. Let's sharpen the debate, Julia, and go to the real yield, which has exploded up to a breaking level. We're breaking, not breaking like snap, but slowing down the American economy. Where's the appropriate 10-year real yield right now? Are we restrictive? And it's got to come down.
Yeah, I think it is clear that the Fed has policy in a restrictive place. We see that in the cost and availability of credit. And yes, when we look at things like the hiring number, the GDP has been a lot more volatile. But hiring's been slowing pretty steadily. And even John Williams said yesterday, the risks are pretty balanced right now. So inflation's been running low. We're going to get another print that's probably going to be in the moderate zone this morning.
Let's go to University of Texas. What's the measurement of CPI you use on an annualized basis? I go to 3-month annualized just because I can't do the math like you can. Do you aggregate a set of numbers like Jason Furman, or is there a Coronado calculus?
Yeah, no, we look at the same 3, 6, 12. 3 gives you the highest frequency, a little bit more noise there. Chair Powell has told us to look at the 6-month annualized. When we look at their preferred measure of PCE inflation, core PCE inflation is already there. It's already
exactly.
At 2%.
So what are we waiting for? Thank you.
So what are we waiting for?
What are
Just
we
more
waiting
confirmation?
for? I want a January rate cut. John, am I out of line?
Possibly, yeah.
Possibly.
That's a little bit greedy, Tom. That's a little bit greedy. I think the January data last year, if you'll recall, we got some changes in seasonal factors in the CPI and some surprisingly strong January numbers. I think that the Fed wants to get through the January numbers that we'll get in February.
Fair.
But if that stays in the zone that we've been in, which is what we expect, then it really does beg the question, what are we doing at 5.5, right? Well, we do not need to be here. The real yield is rising. Hiring is slowing. Everything in the economy is telling them things are balanced. It's time to start adjusting the nominal funds rate.
Julia, John brought this up a couple days ago. Kathleen Bosjancic at Nationwide was brilliant on this yesterday. 2.8% unemployment in Columbus, Ohio. Just as, they're all at the bars, getting ready for football and spring sports. Julia, the bottom line is, if we back up the unemployment rate in Columbus, Ohio, we get to a horrific 4%. Is there a new bad unemployment rate for the Fed?
I think that the Fed is very pleased that the unemployment rates stayed as low as it has. Under the hood, there is some indication that the labor market's a lot more balanced. Hiring has slowed, wage growth has moderated. Employers are telling them, their own district businesses are telling them it's easier to hire and retain workers, a lot easier than it's been. So turnover has slowed down a lot. The churn in the labor market has really, really normalized. So that is where, even though there's a low unemployment rate, the problem with the unemployment rate and fine tuning the economy, the U.S. economy is an ocean liner. If you get to the point where the unemployment rate is rising steadily, you may not have control over that dynamic anymore. The idea of a shallow recession is always a beguiling idea, but the U.S. economy generally doesn't work like that. Once you're in a zone where businesses are laying off workers, that tends to feed on itself. So you probably don't want to get there. And as long as the labor market is not generating inflationary pressures, you don't need to get there. The Fed has some unusually great trade-offs right now that it's facing, and it sounds like they might be willing to take advantage of that and explore the space a little bit by starting to adjust that nominal funds rate lower. Not in January, but we think that by March, the data are going to be telling them that they can begin a process, a sequence of adjustments. Nothing to hurry because the labor market's pretty resilient and solid. But, again, we don't need to run the risk of tipping the economy over.
Julia, you mentioned the rebalancing in the economy. Has that been the product of time, just time past, or has that been the product of Federal Reserve tightening? Can you identify which one it is, and how difficult is that for someone to do?
It's both, clearly both. And when we look at sort of inflation from a sectoral standpoint, you can start to see where it is that the Fed's policies are cooling things down and where it is that just normalizing supply chains and easing pandemic frictions are bringing inflation down. And it's really a combination of both. Actually, the car market's a perfect example of both. Chips are available, production is rising, inventories are rising, dealers are having to compete on price again. That's clearly a easing pandemic friction story, but it's also a demand story because car loans are real expensive at these levels of prices and at these interest rates. Those payments have soared, and dealers are telling us that at these levels of interest rates, there is no more pent-up demand, and they do have to compete on price. So it's really a combination of tighter policy and just an economy that's functioning a lot better.
I ask because I'm wondering how effective monetary policy tightening has actually been, Julia, because we used to talk about, not so long ago, a few months ago, in fact, the longer variable legs of policy and how much was in the pipeline was still about to hit the US economy. How are you thinking about that now, Julia? Is there a channel you're still waiting for that tightening to show up into the economy?
We've clearly seen a lot of the tightening hit the economy. What you see is in the credit multiplier. So if you look at credit flows and the availability and the cost and the amount of bank credit flowing and just the general availability of funding, even for things like in the private equity space, it's a lot tighter. Money is not cheap right now. Money is expensive. Right. You really have to prove your concept. You have to have a cash flow business to get funding, and there's just less funding that's flowing around. That tells us that policy is tight, and that's starting to bite. It's starting to hit the economy, slow it down. We're in a much more sort of trend-like zone for growth. And again, hiring has been slowing pretty steadily and narrowing its base. So we can see policy. Is there more yet to come? I think yes. I think, again, credit flows over time. The less that's flowing, the more that kind of begins to restrict investment and other interest-sensitive areas of spending.
You're the one selected today. Stephanie Kelton, in a podcast text in the Financial Times, regurgitates modern monetary theory, of which she is noted. She goes right after the Dr. Coronados of the economic world. And the basic idea here is debt's okay. With our growth rate where we are, going back to Stiglitz, where our growth rate is, our debt rate is fine, no big deal. You just told me that we've got a slowdown because we're encumbered by debt like commercial real estate, et cetera. Is debt a problem right now, Dr. Coronado?
Well, debt is part of making yields higher. I think that we can see that in the bond market dynamics, that the fact that supply is a lot more supply needs to be absorbed has been a factor leading us to this leg up in yields that we've seen. Is that a problem? Well, actually, the U.S. economy has been functioning kind of surprisingly well at this level of interest rates. Part of that is not about policy. That's about productivity that's been a lot better. And we are a bit optimistic that that can be sustained. So you might be in an area where both because the debt level is higher, but also because productivity is higher, we might be in a zone where interest rates stay a bit higher this cycle than when we were pinned at the zero lower bound and effectively in a liquidity trap. So I think it's a bit of both. It's not that these yields seem to be particularly problematic, but they could stay higher for a longer period of time.
This was the clinic we were looking for. Thank you. Appreciate it. Thanks for catching up. Julia Coronado there of Macro Policy Perspectives, Tom, on the potential for a Federal Reserve to maybe in a position to be thinking about cutting interest rates, not in January, but potentially in March.
My emphasis would be, John, there's 8 ways to slice this. And as we open the show with Mark Cabana's work, part of this is about the financial system. Ben Bernanke's care that we really need to have a robust financial system. I think JP Morgan's doing okay.
That bank is robust.
I'm worried about another 1,000 banks that nobody ever talks about or thinks about.
We're going to talk about those banks up next on the program. Erica Najarian of UBS looking ahead to big bank earnings kicking off tomorrow morning.
The EU EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
There were 3 banks that got it wrong. I've said that publicly. They made choices that were the wrong choices. Wasn't complicated. They got washed up and cleaned up and folded into other banks, and you move on. This wasn't, people kept telling me we're having a banking crisis. I said, no, we're not. We had a crisis among 3 banks. It was a crisis for their shareholders and their employees. It's not a crisis for the market. The core banking system is in rude good health, to use a British expression.
And that was the view of the brilliant Morgan Stanley chairman, James Gorman. The KBW Banking Index showing that good health, rude good health, at more than 25% since the start of October. The first read on the banks this year coming tomorrow with JP Morgan, Citi, Bank of America and Wells Fargo reporting earnings. But Erica Najarian of UBS warning, quote, given the fourth quarter rally in the BKX and a sharp turn in sentiment heading into this year, we think January earnings season may present a speed bump to the sector's recent momentum. Erica, I'm pleased to say, joins us right now. Erica, great to catch up with you. Let's go straight to it. What is it about this earnings, this group of earnings, that you think might be that speed bump?
It's really, to use James' term, a rude awakening for earnings. So it's not necessarily about the absolute price level, and it's not necessarily about the absolute multiple on earnings, but it's that earnings aren't going to go up. You know, as a reminder to everybody, what happened in the rally is we priced out a negative, and that negative was the unrealized bond losses on bond portfolios as Treasury yields were shooting higher. And so now we've removed that negative, but keep in mind that banks are actually positively rate sensitive. What that means, Jonathan, is that, you know, if the Fed is cutting rates, then you actually will have pressure on net interest income, especially in the front half of the cuts.
Erica, I'm looking at your coverage of the big banks, and I want to ask you about banks you don't cover, which I know is out of bounds, but I think it's really germane right now. Do you perceive the divide between 20 or 30 big banks and everybody else out there, and the concern that the smaller banks of America are not in rude good health?
They may not be as strong as the top 20 banks, but I think if the forward curve pans out, they will get a lot of relief in 2 ways. One, they'll get relief in deposit costs. And I think what you have seen in 2023 is a nice run up in deposit costs as the Fed tightened. And so they'll get relief on the funding side. The other piece of relief that those smaller banks will get is on commercial real estate. So commercial real estate is more widely held at those smaller banks than they are on those larger banks that you mentioned, Tom. And as such, if interest rates are coming down, that could actually narrow the subset of potential problems as we deal with commercial real estate maturities ahead.
And so to translate this, to the rescue will be a lower money market yield where billions flows out of money market funds back to a more normal banking economy. Is that right?
Correct. So I love that you hit on that. Not only will you get relief in deposit costs, but you also get that deposit flow back. So you're no longer having to, as an alternative, either, borrow wholesale at, pretty much Fed funds, or really ratchet up what you're offering your deposit customers.
Erica, what is your top pick right now going into earnings season? I know you think it might be a difficult moment, a difficult rocky patch, but ultimately, what is the top pick?
So in a difficult moment, in a rocky patch, who does the market turn to? JP Morgan. So as I think about the expectations that are now into the market, and as I think about the enthusiasm about, having these cuts without a recession, the bank that can deliver on earnings, the bank where we're most confident those earnings expectations can be delivered is JP Morgan.
Okay, I mean, JP Morgan's out. What's it up? It's like NVIDIA. It's like the NVIDIA of the financial system.
Relatively speaking, compared to some regionals.
You're telling me that after massive double-digit return here, complete outperformance, that vector just keeps on going, Erica, for Mr. Diamond?
I think so. So a couple of other data points. So from the October bottom in the BKX, JP Morgan has actually underperformed by 8 percentage points. And remember what I said at the top of this segment. I said it's not really about the absolute price. It's not about the PE. It's about the E. I think that the involvement in the space today is in hedge funds and in macro funds. How long onlys will actually step in and move their weight in banks is they feel more confident that the E is not just bottom, but there is good news upside potential to the E. And again, just going back to JP Morgan, I think they're just in best position to deliver that, and so their performance can absolutely continue from here.
Do we see mergers this year? I've been waiting 25 years for the roll up here, not to get to where Canada is, but we got, what's the number? 4,000 banks, 5,000 banks. How do we cut that in half? This is the year that happens?
I don't think so, because it's an election year. So there's a little bit of a mentality here, the seller's mentality that, oh, wow, I got the bond losses back in my capital as rates have come down. And now they're thinking about what the forward curve is implying and saying, okay, my book value recovery is going to be X higher at the end of the year. And so I want a multiple off of that. Meanwhile, the buyers are like, absolutely not. And the other part of that, and since I mentioned the election, is that, there has been a lot of consternation about the length of time between announcement and close. U.S. Bancorp will tell you about that consternation. And so I think that, smart buyers may wait until we get more clarity on leadership before they think about wading into M&A.
I want to weigh in on the politics if you can. You alluded to it there. It's 2024, it's election season. Are clients asking about the regulatory backdrop going into next year off the back of who may or may not win the election this year? Is it still too early, or is that something they're considering already?
So it's something that they're saying it's too early to price in, given the many variables that could happen between now and November. That being said, they're thinking about, the banks in a positive light if we did have a Republican administration. Of course, a lot of investors are asking